I'm Eric Rosengren. I'm president of the Boston Fed. I'm here to welcome you to our 63rd annual conference. I think it's a really exciting topic, and I'm really looking forward to the next day and a half of hearing a wide variety of views on what we can do about some of the geographic disparities that we see in the United States. So let me start by just talking a little bit about why I found this topic so intriguing. And why I found it so intriguing was the idea of place and the importance of place. So the typical story for many economists had been, gee, we should really focus on individuals, we shouldn't focus on place. We had a conference that was looking at income inequality, and one of the key elements from that income inequality conference was to focus on education. So if we educate people, if we provide them job training, then that's the right way to go. That will help propel them, and they can move to where the jobs are. We don't have to worry so much about the geographic spot that they're located. But what we found over time is that places have been quite different in outcomes, but we haven't seen the population shifts that would be consistent with some of that story, which starts to make us think about how important is place, and do we have the right policies in thinking about place? So if you're thinking about only individuals, you're thinking about how do I do job training, how do I make sure they get educated. If I'm thinking about place, it's probably a different set of issues that we have to address to make sure that that place can actually use the funds in an effective way. Do you have an effective government? Do you have an effective social infrastructure? You have effective employers that all can work together in a cohesive way to actually generate a different outcome. So from a public policy standpoint, I think it's really interesting to think about, if we're going to think more about place-based policies, what should those policies be? And I'm hoping over the course of the next day and a half that I'm going to learn a lot from everybody in this audience who spent a lot more time thinking about it than I have, about how we can do this in a much better way. I think there's some interesting trends just to highlight. It used to be that we were seeing much more convergence. We're not seeing the same kind of convergence that we were seeing before. We used to see a lot more migration from poor to rich areas. We're not seeing as much of that migration. So we have to start thinking differently as we start seeing these different kinds of economic trends. I think over the course of the next day and a half, there are going to be a variety of issues that we're going to be addressing that I think are really quite fascinating. So why are these geographic differences so persistent? Why have economists who previously were focused on people moving starting to think very differently about regional economic shocks and how we should address regional economic shocks? Thinking about quality of education, quality of healthcare, not only what's available in these communities, but how that affects people's outcomes over their lifetime. And thinking about how we can think about the rural and urban divide, which in many situations has gotten much worse. So I think that over the course of this next day and a half, we're going to be trying to address a lot of these questions, and hopefully most of the papers and most of the questions will also get back to not just stating what the problem is, but thinking a little bit about what the solutions to the problem is, because I think in many cases the problems are visual and the solutions are less apparent. So it's, I think, really important to understand that. So you might wonder why it is that the Federal Reserve's involved in this topic in the first place, because you think about setting interest rates and monetary policy, and that's certainly one of the key functions of the Federal Reserve. But I actually think that our dual mandate is encompassing something more in terms of welfare dynamics, about trying to change the quality of life for everybody who lives in the United States. And so we've been very focused over the last few years on thinking about how we can make sure that New England as a whole does better. So we're fortunate that New England is much better off than many other parts of the country, but you don't have to go very far north of Bangor, Maine, to see some really striking rural poverty. You can see it in Vermont, you can see it in New Hampshire, so you can see it in Boston as well. But I think an important insight is that poverty is not just a city outcome, it's an outcome that is very frequently found in rural and small cities. So what have we been doing? Well, we've been trying to do research in the area, particularly thinking about how some of the manufacturing, textile migration has affected smaller cities in New England. We're doing convenings like this conference. So we've had a conference that focused on income inequality. This conference is focused more on the geographic disparities. I'm going to talk in a minute about the Working Cities Challenge that we've had, which is actually a place-based endeavor to try to change the story for some of the smaller cities in New England as well as some of the rural areas. And then I would say that the Boston Fed has always cared a lot about labor dynamics and contributing to the national monetary policy story of how to integrate all these things into a coherent framework. So that's why the Fed's interested. So nationally, we're seeing superstar cities are really attracting more people and businesses. You can see that in Boston. You can't see it out through this window. When we go to the reception tonight, you're going to look out at the Seaport area. 10 years ago, it was a parking lot with ocean views. It's now basically another city. The Boston Fed, when I first came here in the 80s, was around an area that was the combat zone. The combat zone's been completely priced out of the market, so there is no combat zone. We had been at the edge of the city. We're now getting to be in the middle of the city. So Boston's doing really well. And when you go to the Seaport area, you're seeing new restaurants. You're seeing a lot of young people. You're seeing a lot of well-educated young people. So Boston is thriving, and I'm going to argue that there are other places in New England that have a similar story, but then there are rural areas that are having much more of a challenge. It's older, not younger. It's less educated, it's not well educated. Incomes are growing more slowly, and the health outcomes are not nearly as good. So there's a striking disparity even in New England between the urban centers that are doing pretty well and some of the less urban areas that are not. So I know a lot of people in this room have done a lot of work thinking about the role of education. And I would emphasize that economists have, and many economists in this room, have really focused on the fact that education and the wage premium you get for getting a college education is quite high. One of the important aspects of that is that college-educated people are not dispersed randomly across New England. They actually tend to be aggregated in some of the cities. So it does create a challenge if a lot of the wage premium is going primarily focused in communities that are successful in drawing college-educated individuals. There's going to be a paper that focuses on health outcomes, but this is looking at kind of the ultimate in health outcome, which is life expectancy. And it's looking at metropolitan versus non-metropolitan areas. And when my staff showed me this chart, I really found it quite striking how that divergence had grown over time in terms of health outcomes. So it's not just kind of an economic story, it's really literally a quality of life and length of life story that we're going to be addressing over the course of the next day and a half. So geographic disparity is an important part of New England, and I'm going to make a comparison between 3 of the cities and the states that they're in. One is Burlington, Vermont. The other is Portland, Maine, and then, of course, Boston. So if you go back to 1960 through 1980, most of these cities were not performing all that well. And it was kind of striking. These were kind of gritty cities. And they seemed gritty. They were cities where manufacturing base had disappeared. In Maine, it was more, it had been a lumber area. Lumber obviously wasn't doing as well. Massachusetts, and the eastern part was textiles, western part was manufacturing. But as all of these businesses migrated to the south or abroad, you started to have very depleted cities that weren't doing particularly well. Now you look at these cities and it's a completely different story. They're young people, they're educated, the population's growing. Outside of the primary cities, the opposite is true. So this looks at those 3 cities. And so this is looking at the percent of US metro area per capita personal income. And you can kind of see that as we're getting into the 70s, as the manufacturing, textile, lumber was a problem, you can see that in all 3 of these cities, there was a dip. So at that time, Boston had dipped down to basically where the national average was. Portland and Burlington were substantially below what the national average was. But then you look over the next 40 years, and there's been a steady increase. So Boston certainly has done quite well, but certainly relative to where Burlington and Portland were in the late 70s, That's quite a trend line that they've been quite successful relative to what was happening in the United States and are now above that average. Now, if you start looking at what that means for outcomes, this is looking at the population. So again, it's going to be looking at each of these three cities, and it's comparing to what the outcome is in those states, taking out the Boston Metro. So the Boston Metro includes parts of New Hampshire. There are plenty of people who work in this building that actually commute down from southern New Hampshire. So that's why we've combined New Hampshire and Massachusetts. You can see while Boston has had population growth, outside of Boston, Massachusetts and New Hampshire haven't had the same kind of growth. But it's even more striking when you get to Vermont and Maine. So Burlington and Portland both have had reasonably good population growth. At the same time, you've seen some reduction in population outside of those city areas. In terms of the kind of population that many businesses are looking to attract, the population between 20 and 40, in each of these cities you can see a difference between what the primary city is doing and what the rest of the state is doing. So you can see there are more young people in Boston, which is not all that surprising, as well as in Burlington. Portland, not so much. I would highlight an important difference between Portland and these other two cities. University of Vermont's located in Burlington. One of the key features of Burlington, Vermont is that university. It's kind of, if you haven't been there, it's a funky, fun city. And it's partly a funky, fun city because it has a lot of college students there. And one of the reasons Boston's attractive is for the same reason. Everywhere you look, there's a university in Boston. And so it does attract a different kind of population. Portland, Maine, the main campus in Maine is in Orono, close to Bangor. And so they don't have a college-centered primary city. And so you don't see quite the same population differences as you see in those other two. But nonetheless, in all three, they're doing better than the rest of the state. Looking at the share of population 65 and over, you can see that in the cities, less of an older population. That makes sense. Cities are expensive places to live. If people are on a fixed income looking for a less costly place to live, it's not completely surprising that you'd see more older people. But it does have implications for the community when you're disproportionately old relative to what's happening in the cities. So we had spent some time looking at these disparities and seeing what the differences were. And then we started looking at what some of the outcomes were for various cities. And so this is a chart that looks at cities starting basically in 1960 through 2010 and asking what the economic outcomes have been. These cities were not randomly picked. These are the cities with the highest poverty rate and the lowest family income. But an important context is, if you look back to 1960, there's some that aren't doing that well, but a bunch of them are right around the median family income of the nation as a whole. What's striking about this chart is how little success over 50 or 60 years has occurred. So in each of these communities, they've been losing ground relative to the national average for a really long period of time. Well, that is really challenging. And so when we looked at this chart, we asked ourselves, well, is there something that we can do? And one of the things that we started thinking about was the value of place. And so we have a competition called the Working Cities Challenge, which is bringing in foundation, national foundation money, working with the state and working with businesses to actually fund some of the cities. The cities that won our first competition in Massachusetts was Lawrence, which is the orange line. So you can see they started close to the average overall for the United States. They're the worst performing city in Massachusetts over this period, so they were one of the winning cities. The second is Holyoke, the third is Chelsea, the fourth is Fitchburg. So three of the four are the bottom three lines on this chart. We didn't pick them because they were the cities with the greatest need. We actually, and it wasn't the Fed that picked them, it was actually an outside steering group that did it. And if you're interested in hearing more about I don't have in my limited time enough time to talk about this, but if you type working cities or working communities, you'll hear about what we've been trying to do in this area. But these are the communities that we focused on to try to tell a different story. And part of the reason that we thought it was important, this is looking at the grant recipients, so those 4 cities that I just highlighted, versus the rest of those cities in those lines. And you can see from 60 to 80, there was a loss of population. But over the last 30 or 40 years, their population has actually grown. So if your solution is that cities that are not performing well are just going to have people migrate to cities that are, the fact that these cities over 50 years have done so poorly and yet people haven't moved, actually over the last 30 or 40 years, these populations have grown. Now the population has also changed. So if you look at many of these cities, it has a very different composition in terms of ethnicity than it did 40 or 50 years ago. So if you look at a city like Lawrence, which was the orange line in that previous chart, it's basically turned into a primarily Dominican, Spanish-speaking community. That's not the way it was 40 or 50 years ago, but that's accounting for some of this population growth. Chelsea, another one of those cities, which is actually just, depending on where you are in the building, you can actually see Chelsea. Chelsea's in visual distance of seeing downtown Boston, but it's been kind of a new immigrant city for a very long period of time. It's a city that has changed quite dramatically. So each of these cities have a large immigrant population. So if your answer is just to get people to move, that doesn't look like the solution, at least for the cities that I just showed you in Massachusetts. And actually, I can show you the exact same chart for Rhode Island, the same downward trend for the cities that were not performing all that well, have not performed over the last 50 years. You see the exact same trends in Connecticut as well. So it's not isolated to Massachusetts. Actually, all of southern New England has this attribute. So one of the questions we asked ourselves is, Boston, Portland, Burlington have all been able to tell a different story. Is it only the primary cities in these states that can tell a different story, or is it possible that some of these other communities can tell a different story as well? So we focused actually on communities that we thought had the highest probability of success, and the way we defined that was they had a cohesive vision for their community, which is that the government, nonprofit, and business all agreed on what kind of solutions they wanted to focus on, collaborated well together, and could come up with cohesive projects that would tell a different story over time. We've done this type of competition in Massachusetts twice, once under a Republican governor, once under a Democratic governor. The governor of Rhode Island and the governor of Connecticut both asked us to do competitions in their states as well, so we have done that. This isn't Federal Reserve funding, it's foundation funding, it's state funding, and it's business funding. And we're now doing a Working Communities Challenge, which we're just launching in the state of Vermont. We recently launched, though the cities or the communities have not been picked, and we're hopefully going to be launching in Maine this fall. So it's a model that we're spending a lot of time thinking about. I think we've seen some positive success to date. We're certainly seeing that in terms of the initial grants for those 4 winning cities, it was only $1.6 million. It was pretty short money, but they've leveraged it to $11 million in follow-on funds. So other foundations have decided to invest in the same set of cities. That's a pretty, just looking at the fact that other foundations were willing to focus on these cities. These were cities that had not been getting National Foundation money before. One of the goals of this competition was actually to get national foundations to spend more time outside of Detroit and Newark and very large cities that clearly have problems, but also to think about some of these other communities. So this competition, I think, has been successful in redirecting at least some of the foundation money to be thinking about these communities. But it's also to get the state and business leaders to be thinking a little bit differently about these communities as well. On our website, we have an outside evaluator that talks about some of the changes that we've seen and goes into a lot more detail. But I think we have already seen some success, and part of our goal was to get a system change, which is to get the states to start thinking differently about these communities and not just spread the money around generally, but to think about which communities had the highest success rate and what kind of things that they needed to look for in order to be able to get a higher social return on the money being spent in these communities. So we need new policies. The last 50 years in many of these communities have not worked. We're trying one way. I think we're going to hear about lots of different ways that we can think about how to tell a different story about place. But I think the solution is not to throw up our hands and give up, but actually to think about, let's think about different solutions. Let's experiment a little bit more. One of the nice things about smaller cities and communities is there are a lot of them. So we can do a lot of experimentation to see what works and what doesn't work. I think this conference is going to really focus on what more we can do about place, and I think that's really important. So I'm looking forward to seeing all the papers and understanding what we should be thinking about differently in terms of telling a different story in New England. I think our Working Cities, Working Communities challenge really gets at the heart of the kind of questions that this conference is asking. And we know these are tough questions, and we know we haven't had a lot of success over the last 50 years. That makes it all the more important for us to be even more focused on success going forward. So I really look forward to the papers and all the discussions over the course of the next day and a half. Thank you for being here. I think it's going to be a really exciting day and a half, and look forward to seeing the next round of papers. And with that, I'll have Jeff and his panel come up. Thank you.
All right, before we start good morning. My name is Jeff Thompson. I'm a senior economist, policy advisor here at the bank, and director of the New England Public Policy Center. I'll be moderating the morning sessions, and before we kick off with our first paper, and which will be presented by Chris Foote, I want to give a few housekeeping items. First of all, just to let you know that restrooms are located just outside those back doors, either off to that direction or back near the elevator from where you came in. Second note is that breaks and sort of snack coffee items will happen out here to my left, your right, and lunch will be served in the cafe, which is out the back doors to your left and my right. And also to let you know that we are pleased to have many members of the media among us today. And just to very quickly mention that the ground rules for the press coverage is that all presentations and general discussions during the conference session are on the record. Any informal or social elements of the gathering, conversations over breakfast or lunch are off the record unless otherwise specifically agreed to by the parties. And we will be live streaming the whole event, so we're all on camera, and it will be posted to the live streamed to the website. So anything said during the conference session will be viewed by the entire public. So we'll go ahead and start, and the presenters will have 25 minutes, the discussants will have 20, and then we'll have 30 minutes of discussion for the general audience. So with that, I'll hand it to you, Chris.
Okay, great. Let me say at the outset that even though Ben and I both work at the Boston Fed, the views are our own, and we're not speaking officially for the Boston Fed or the Federal Reserve System. Now, our goal in this paper is to set forth some basic facts about the spatial distribution, or spatial evolution of labor markets over the past 5 decades. And that's a pretty ambitious task, in large part because there's several dimensions over which labor markets can vary. There's the rural versus urban dimension, center cities versus suburbs, or superstar cities versus less successful cities. And if we wanted to say something about each of these potential dimensions, we thought that we should take the county as our unit of analysis. So our main data set is going to come from the County Business Patterns, which is available yearly from 1964 to 2016. We have employment in that data set, both total employment, which is essentially private non-farm, and manufacturing employment, which we sometimes have to impute from an establishment size distribution. We also have payrolls, which we can combine with employment to get average earnings per job. To create the data set that we work with, we're going to combine some small counties and independent cities in Virginia, exclude Alaska and Hawaii, which gets us from about 3,100 official U.S. counties to a balanced sample of 2,900, about 2,900 counties in our data set. And in our work, we'll also use some county-level demographic data from census. Now, the first thing we're going to do with the county-level data is group the counties into 4 groups based on population density, and then we're going to make some maps. And we're going to choose a non-standard color scheme for the map in the sense that we're going to graph the rural counties in red and the more urban counties in blue. That's a joke, by the way. I'll point out the jokes as I go along so you know when to laugh. The densest group is the single top percentile in population density, and they appear in dark blue on the map, which you can see is for the Northeast Census region. And there are all these dark blue counties are all sort of centers of dense cities. The next 2 groups, the 96th to 99th percentile and the 86th to 95th percentile, are either suburbs of big cities or the centers of smaller cities. And taken together, the densest 3 groups account for exactly 15% of the counties, but about 70% of the US population. And the least dense group in red is going to include both what we think of as rural America and sort of outlying suburbs and jobs move in there. But also because around half of these tan counties are centers of smaller cities, their growth reflects what Jordan Rappaport of the Kansas City Fed has termed the growth of large, less crowded locations. And Jordan's research indicates that for cities that have non-trivial, substantial population, but are still sort of have room for people to move, those are sort of cities and counties that have grown more quickly recently. Now, an interesting facet of both of these graphs is if you look at the top percentile in terms of density, it looks like those top dense counties, those dark blue counties, have done a better job sort of hanging on to their shares of both population and employment in the national data. And that's consistent with what we've seen, and actually on the other end of the spectrum, whereas we've seen sort of a stabilization for the top counties here, you've seen sort of a tick down in sort of the least dense counties in terms of their shares. And that sort of opposite effect, or the opposite results there, is sort of consistent with what's been widely noted, that big cities seem to be doing better than rural areas in the last couple of decades, since about 2000. Now, the fact that the densest counties are holding on to their national shares leads naturally to the study of suburbanization, because suburbanization is really all about how the dense center of an urban area is sort of hanging on to its employment and population versus seeing that employment and population spread out. And we take up that question in this slide. Now, we're going to define local labor markets here in the same way that it's defined in a lot of current macro labor research, which is as commuting zones. And these zones are approximately 700 zones that are put together by the Department of Agriculture to reflect local labor markets. And they're a lot like metropolitan areas, except the commuting zones cover every single county in the country. Now, we further group or classify the commuting zones based on the density group of their densest county, which we're going to label as their center county. And then we ask what's happening to the shares of total employment and population in that center county for the different groups of commuting zones. Now, if the center county shares are declining, what's happening? Well, population and employment is moving out. That's suburbanization. And again, that way of measuring suburbanization is also common in the urban economics literature, although they often use metro areas. Now, the dark blue lines in each of these panels are the center county shares for commuting zones that have one of these dark blue top 1% counties at their center as their densest county. And as you can see, for most of the sample period, you see that those shares decline. These declines are consistent with the long-standing trend towards suburbanization that Ed and Matt Kahn and others have written. But interestingly, it sort of flattens out. These lines kind of flatten out after 2005, both for employment, or both for population and for employment. So even though there's been a long-standing trend, something has changed. Something has changed relatively recently, that suburbanization in these dense CZs with very dense centers has stalled. You can then next consider, what about the commuting zones that have sort of the light blue counties, the center county that's in the 96th to the 99th percentile. Well, for population, you also see sort of a flattening out. But for employment, you don't. You see sort of a shallower downward decline, but there's not much change here in 2005. Now, for the commuting zones with less dense, in center counties of even lesser density, the CZs with red counties at their center or the tan counties, you never really see much of a trend towards suburbanization, probably because there's not much pressure, because the center is not very dense to begin with. Now, taken together, we think that the population data support the idea that larger cities have made a big resurgence in the 21st century, and as a lot of people have noted, sort of living downtown has become more attractive. But the fact that you see sort of employment decentralization, employment suburbanization continue for cities, the 50 or so cities that sort of are commuting zones that have sort of the next tier level of density at their center, the fact that that's continued indicates that to us there's not a lot of evidence that there's some production externality that's become larger in cities that's drawing people together in terms of their employment. Rather, it's consumer amenities that is making downtown living more attractive, and that's why you see it in population. Now, we next ask what can be learned by evaluating the earnings per job data that's available in the county business patterns. Now, these graphs show binned scatter plots of average earnings per job by density percentile, all 100 of them, for the first and the last years of our sample period. And the data are demeaned with weighted from they're demeaned from population weighted averages of earnings, so there's a zero line in each panel. And the reason that that zero line appears above most counties is that most people live in the rightmost part of the density distribution, and that's where wages tend to be higher. So that pulls up the weighted average of earnings above most counties. Now, Ben and I call this graph from crooked smile to hockey stick. And at the start of the sample period, you can see that there's sort of a fairly linear relationship between density and average earnings per job in the part of the distribution where most people live. But by 2016, that has changed, and you see more of a hockey stick shape in which the very dense counties are sort of pulling away from everybody else. The more urban counties here are sort of pulling away from the pack. You don't have to graph just means, you can also graph the 75th and the 25th percentile to give you an idea of dispersion in average earnings per job as a function of density. We've done that here. Now, if you eyeball this graph, actually it should make clear that because we're graphing the 75th percentile and the 25th percentile, the gap between these two lines is the interquartile range at each density percentile. Now, if you eyeball these two figures, you sort of can see that the average gap looks bigger in the 1964 graph than in the 2016 graph. And you can actually, of course, check that simply by taking the average of this gap throughout the entire distribution. That's the average gap for 1964, compare it to the 1965, 1966, and so on. But you could also, since we're doing non-parametrics here, you could also take the average over any particular segment of this line. The bottom 85 percentiles, from 85 to 95, the top 5%, and so on. Now, here's what you get when you do that. When you take the average gap across all of the density percentile distribution and graph it, what you sort of see from your eyeballs actually is verified by the graph. The average gap is larger at the start of the sample in 64 than it is at the end of the sample in 2016. You see a decline here. If you take it just over the bottom 85% of counties in terms of density, not surprisingly, 85 is pretty close to 100, so you get a very similar picture. You also get a similar picture when you graph just the average gap over the percentiles 86 to 95. The most interesting slide, the most interesting panel here is this bottom right panel, where we look at the average interquartile range by year just for the top 5%. And what do you find? Well, you don't find much of a decline in here, but you find a very large increase in dispersion at the rightmost part of the density distribution that starts around 1995. Now remember, the top 5%, those are the light blue counties and the dark blue counties, and that's about where 45% of the country lives. And that, to us, is sort of evidence of this superstar cities phenomenon. The fact that you're seeing dispersion in the more urban counties that begins around 1995. Now, a more precise way to analyze average earnings per job at the county level is with regressions. And in our paper, we run a series of yearly regressions. We don't run one large panel regression, even though we could. Because what we want to do is we want to see how the correlation of average earnings per job changes with particular potential regressors over time. So the regressions are going to be run separately year by year. The dependent variable is exactly what we've been looking at non-parametrically, average earnings per job. And the potential regressors are average January temperature, which I know is one of Ed's favorite regressors, reflects the rise of the Sun Belt. Also log population density and an indicator if the county is in the top 5% of density in that year. The manufacturing share of employment, the log share of persons with a bachelor's degree in that county, which we interpolate from decennial census data and from the American Community Survey. So we'll allow these regression coefficients to change over time. Now, I don't want to get too deep in the weeds, but I do want to note that as a technical detail, we'll also take the spatial nature of this data into account in a couple of different ways. One is that for two variables, log density and the manufacturing share, will not only include the own county value of that variable, but will also include weighted averages of bordering county data, and that's what this WX term here is. The W is a weighting matrix that constructs weighted averages, and we specify that W matrix to have a particular form. It's a second order contiguity matrix, which sounds fancy, but it's really easy. It's basically the idea that neighboring counties are those which border a particular county and which border the bordering counties. That's where you get the second order piece. A second spatial detail is that we're also going to allow the residuals in each of these yearly regressions, these yearly slices of the data, to be correlated. And that's this notation right here. That's really important to do in order to sort of get the proper standard errors. It also helps with efficiency. But as a side product, we will estimate the strength of the correlation of residuals, the clumpiness of residuals in our regression over time, and we'll be able to use that to sort of understand a little bit more about the data as well. Now, to give you an idea, this is what I just said, to give you an idea about how this W matrix works, this is a graph of manufacturing shares in our counties in 1980. And this is what happens when you take the average, weighted averages of nearby counties. You can see that what's being picked up here is sort of a local area effect. Now, a side benefit of looking at data from a specific year, 1980, is that you can see that by 1980, the big manufacturing areas in the country were not only the upper Midwest, but it also moved to the South. In North Carolina, by the way, for you pub trivia fans, in 1980 is the highest state, or the state with the highest manufacturing share, not Michigan or Ohio. So in the interest of time, I'm actually going to skip the January temperature coefficients. Sorry, Ed. And then I am going to just focus on the density coefficients. Now, in the left panel, the solid line shows you the linear effect of density, the coefficients just putting in log density. And the dotted line, or the dashed line here, shows you the effect of the nearby density. In the right panel, those are the coefficients on the dummy variable, the indicator variable, for whether or not the county is in the top 5% of the density distribution in that particular year. And if you look at this graph, you can see how we can get a hockey stick shape in the non-parametric stuff that we showed earlier. Because the top 5% here, this indicator is pulling away for the rest of the country. And a nice thing about running these regressions year by year is you can see when that happens. It happens sort of around the early 1980s. The linear term here changes a little bit at that time, but not much. But overall, sort of you can see that just the linear effect of density declines. A lot of the action is just being picked up to the extent that density is rewarded by the regression in terms of in explanatory power. It's being picked up by this single indicator that indicates whether the county's in the top 5%. Now, as Eric showed in the opening graph, or one of his opening graphs, the early 1980s were also a period in which the college premium started rising. We do have a rough education regressor in our model. As I said, the log share of bachelor degrees. And interestingly, and perhaps somewhat miraculously, it also starts rising in the early 1980s at exactly the time the premium estimated on individual data does. Not only that, but it flattens out over time, although it's sort of a little hard to see exactly when that flattening out happens, whether it's in the 1990s or in the 2000s. If you look at the share manufacturing regressors, here I've graphed the solid line is the own county share, and the dashed line here is the coefficient on the neighboring county share. And the solid line is interesting. You can see that if you have a high own county share of manufacturing, you're likely to have higher wages. Now, of course, in this particular county. Now, of course, that could be a mechanical effect. Because manufacturing employers tend to pay high wages, if you've got a lot of manufacturing employers in your county, guess what? You're likely to have a high average. The nearby manufacturing share comes in negatively. We don't think that is a causal effect. Rather, what we think it is, it's reflecting the location decisions of manufacturers. They want to locate in areas that have relatively low wages. So what's that going to do? Well, holding constant a county's own manufacturing share, being located then around a lot of other manufacturing counties would tend to reduce wages. Now, the last set of estimates is for the lambdas that measure the strength of the correlation in the residuals. How clumpy are sort of average earnings across different counties once you account for all of these right-hand side variables. And interestingly, what you can see is that the regressions or the residuals start out to be pretty clumpy. That's not an official econometrics term, but it declines over time until 2000, when all of a sudden the residuals become clumped together more intensely. Now, our hypothesis is that this is sort of another implication of the superstar cities phenomenon. Starting in the mid-1990s, these superstar cities pull away from the other cities. What would you expect to find? Well, as we found with the non-parametric analysis of the interquartile range, you'd see, on average, dispersion of residuals rise. But because superstar cities are really superstar metro areas or superstar commuting zone, you'd have a lot of the counties or all of the counties within those labor markets move apart at the same time. So you'd have an increase in the clumpiness, the correlation of the residuals as well. Now I have a slide that sort of reviews the main results and how they tie back into the spatial dimensions that we talked about earlier. But rather than review that, in the interest of time, I just want to touch on very briefly a couple of points we make in the paper about the manufacturing share. Essentially, we move the manufacturing share from some explanatory variable and make it the star of the show and ask what's been going on with manufacturing shares in the different counties that have different densities. And as often been noted, there was a big rotation of manufacturing employment out of dense counties and into less dense counties early in our sample period. So this shows you growth rates, annualized percentage growth rates of manufacturing employment in our selected years. So this bar here shows you the growth rate for the least dense group of counties, the red counties, between 1964 and 1973. So even though the share of manufacturing in the United States is declining, outside of dense cities, and particularly in these less dense areas, manufacturing employment is actually growing early on. Now what happens though is around 2000, a gun goes off and manufacturing employment falls very sharply everywhere. It becomes, as you might say, the 21st century was not a great period, not just for manufacturing in dense cities, which is the case in the 70s and or 60s and 70s, but for everywhere. Now, our paper makes a couple of points about, or raises a couple of questions about this, and I'll just touch on them briefly. One is, why have recent declines in the U.S. manufacturing share have had such a large effect on local communities? As I said, and as I'm sure you're aware, the average share of manufacturing employment in the United States has been declining for most, if not all, of the post-war era. But yet it seems like more recently, declines in manufacturing have had larger effects on local communities. Now, as we'll hear later on in this conference, part of that discrepancy, part of the reason why the more recent declines in manufacturing have hurt communities worse, is that the communities that have been hurt worse recently may be different in the sense that they have lower levels of human capital. We just develop another angle in the paper, a complementary explanation, in which we sort of use a spatial error model to discuss sort of whether or not counties that lose manufacturing jobs today are counties which are sort of packed together with other counties that have high manufacturing shares, or whether they tend to be sort of counties that have high manufacturing shares and surrounded by non-manufacturing counties. And we make the case that more recently, it's the sort of clumps of manufacturing counties that have been hurt worse, or at least as bad as the earlier declines in manufacturing employment occurred. And what's happening is, because the sort of manufacturing counties are all packed together and being hurt, they have less chance to diversify. We provide some statistical analysis of that, and we can come back to it in the general discussion if you're interested. And here's just the stuff here. A second point about the manufacturing share relates to some recent work that people have done on within big city inequality. I won't say much about that, other than to note that when we look at the types of jobs that have been lost in big cities, manufacturing jobs were lost in the 60s and the 70s. More recently, though, other types of jobs, office support jobs, have been lost. And in the paper, we talk about how the loss of those office support jobs probably tie into the increase in big city inequality more than jobs lost in manufacturing early on. Because the increase in big city inequality that we've seen has happened relatively recently, in the 2000s. The manufacturing jobs were lost way before then, but we talk in the paper about office support jobs and other sort of non-college middle skill jobs that have been lost that may be contributing to higher big city inequality today. So with that, I think I'll leave it there. Thanks. Thank you.
Great. I'm very grateful to have the chance to discuss this fascinating paper, and I'm so grateful to the Boston Fed for hosting this conference. These topics are of a first-order importance to our nation, and it's really wonderful to have a group of scholars and people with strong policy interests coming together to discuss them. I am haunted by this picture. So this is a map of prime age, 25 to 54-year-old, and I find that definition of prime age as offensive as many of you do. Prime-aged males not working rate throughout the U.S. And I think it's important to remember, as the unemployment rate gets to vanishing low net levels, that we still have a jobless problem in this country. We still have 10% of prime-aged men who have left the labor force, and they are not spatially uniformly distributed, right? They are particularly evident in an area of America's eastern heartland that begins down in Mississippi and Louisiana, runs up through Appalachia, and ends in the Rust Belt cities. In many of these areas, more than 1 in 4 prime-age men are jobless. And if we have a policy mission, it is to figure out somehow or other to reduce the enormous social dysfunction that is associated with these massive levels of prime-aged male joblessness. This is the same map using the same color scheme for 1980. There's still a regional pattern that is slightly discernible, but of course the whole level was so much lower. Right? We've gone from a world in which 5% of prime-age men were jobless to a world in which 15% of prime-age men were jobless in the country as a whole. Just the levels are just at a totally different place. And this is the same map for women. The levels of not working are much higher, of course, and it follows more of a regional barrier. And of course, it's a much more complicated topic in many ways. Women who are not formally employed are typically not miserable the way that men who are not employed typically are. And moreover, they're also doing socially useful things like taking care of kids and doing other stuff, whereas men who are not worked are typically watching television, right? That's our primary time use fact on this. Okay, so this paper by Couillard and Fote, which is excellent, really adds a great deal to our knowledge, has an arc, and that arc relates to the overall arc of urban history. So if you think about the last 200 years, in the 19th century and early 20th century was the great movement of factories to cities. Cities invented new industries like mass-produced cars in Detroit, and they grew great around automation. But in the 20th century, factories left, and in some sense, manufacturing was never a good fit for urban density. Manufacturing is capital intensive, often land intensive, and once the sort of initial breakthrough phase was over, it always made sense to de-urbanize things. And of course, the nature of factory production has totally changed. In 1910, Henry Ford had factories that used about 200 square feet of space per worker, right? Today, Ford and GM are at 2,000 square feet per worker, and that's just a very different mode of operation that requires a very different location. Late in the 20th century, somewhat remarkably, educated, dense urban cores have done well as consumer cities, as well as places of knowledge-heavy production. Couillard and Fote have put together the county business patterns data in a usable, sensible fashion that will serve many of us, right? I well remember the deep pain of hand-entering the 1956 county business patterns data in 1989, 30 years ago, and it's wonderful that they've done this. They have an interesting arc in the paper, which is they begin with urban centralization, then they talk about manufacturing's ongoing decline, then they come back to patterns of earnings and earnings disparity across counties. I think the basic issue here is they have two papers which are dividing their own house within this paper, one of which is a deep and fascinating paper about the heterogeneous effects of manufacturing's decline on place, right? That is a paper that absolutely should be written on its own. And the second paper is one which is charting the different paths of earnings and population and employment across the U.S. using county business patterns over a 50-year period. My main comment for the first paper is for the paper on the broad paper is to always focus on employment, population, housing prices, and wages simultaneously, right? Don't split those things up. It is by using those moments of the data together that we figure out if what's going on is a rise in labor demand or a change in labor supply, an increase in the amenities of an area or a change in housing supply that makes it easier to house people. Bring those things in and use the FHFA housing price data as well. There's no reason not to do that. For the second paper, I would be more focused on not only the heterogeneity between today and in the past, but the heterogeneity between different areas in terms of the manufacturing decline, because I think those patterns will bear rich fruit. There are 5 interesting facts here in the paper currently. The suburbanization of population and employment in very dense cores stopped after 2005. Is this an urban comeback, or is this merely a reflection of the Great Recession? In less dense cores, the suburbanization of employment continues, but the suburbanization of population has slowed considerably. Is this a consumer city phenomenon, or perhaps something about the nature of housing supply? The mean earnings to density relationship moved from being a U, or a crooked smile as they put it, to being an upward line. So they skipped over the middle decades where it's just sort of a straight upward line to this hockey stick, which shows this sort of clear convexity in the relationship later on. This is a great fact, and I'd love to sort of learn more about this. And there's a nice fact on own manufacturing being a plus, but neighboring manufacturing being a minus for earnings. Earnings dispersion across counties with similar density levels fell throughout the 1990s, but then subsequently rose in dense counties. This is an important thing to remember, right? That so often we, have conferences like this and we act as if earnings disparity across the U.S. is some kind of a new phenomenon. Not only is it a new phenomenon, by many measures, in many cases, it's actually less than it's been in the middle parts of the 20th century. In 1950, Mississippi was the poorest state in the Union, and there were 18 states in the Union with per capita incomes that were more than double that in Mississippi. Today, Mississippi is still the poorest state in the Union, but there is not a single state with a per capita income that is double that in Mississippi. And they show that in this data. The last point, which is nice, is that the decentralization of manufacturing has been a major part of the urban landscape since the 1960s. But starting in the 1990s, manufacturing employment started dropping as much in rural areas as in urban areas. And that's sort of an important phenomenon. Part of the malaise in the Eastern Heartland is the end of this manufacturing. Okay. So this is their fact about population, employment, and across these areas. Now, I want to highlight how novel and interesting it is to do this grouping. Okay, it's a really nice grouping. It's a grouping that reflects the population weights. And I'll just tell you what happens if you group it by counties, let's say over the past 10 years, is you basically see a straight linear relationship between population growth and initial population density, and then a decline for the densest tenth of counties. Okay, that's because the densest tenth of counties, which includes a very large share of America, is being split up into sort of three groups here. And those bottom 8 deciles, all of which show this strong positive relationship, are being grouped together in the 1 to 85 category. Okay, I think both are totally legitimate ways to break it up. In some sense, I am more empathetic for what they're showing. And this is showing the sort of urban comeback is this flattening off there in terms of the top 1%, or the relatively good performance in the 86 to 95% area. There's also this interesting fact that the population growth has done better in those mid-range density areas in the past decade than the employment growth. And again, this is the sort of comeback to mid-sized cities. It would be one of the reasons we knew to expect that, okay, is because prices are a leading indicator. We've had for many years the fact that there's been this tilt, and this is using Zillow data, this is proximity to the central business district, this is across the entire United States. There's a huge price tilt, okay, across the U.S. towards central city areas in terms of living. And that's why I think it's always important to sort of combine the price data with the population data to actually show this and to show that this is clearly something in terms of demand for city space, either reflecting jobs that are available, I think more probably the amenities that are in the area. We also see something like this in the permits data. So this is the path of single-family and multifamily permits across time through 2006. Right, massive gap that favors single-family permits. After the Great Recession, a real balancing out where single-family and multifamily look much closer together. That again sort of suggests this rise of the central cities. Now, what lies behind this? I think it's interesting to speculate, but that the changes in technology that were once thought to be the death knell of urban areas have proven to be highly complementary to urban form. One of these is the so-called sharing economy, and cities have always been about sharing. What is an urban restaurant but a shared dining room and a shared kitchen? What is an urban park but a shared backyard? The difference is that these new technologies enable us to share more stuff. Why didn't you have ride sharing in Boston in 1975? Because you'd go to the combat zone to pick up your car and there'd be like a dead body in the trunk. And it'd be sort of an unpleasant thing to explain this thing. Today we have the technology and you're not finding the dead bodies anymore, and so we can share more stuff, and this enables cities in different ways. This shows Yelp coverage relative to the actual restaurants across America. And you can see as well, like these forms of information sharing online seem to be deeply complementary with urban form. And so far from enabling us to spread further over space, many of the new technologies seem to abet face-to-face contact or to abet the communal use of resources. I would also like to see in this sort of broad discussion more discussion of the joblessness problem. So this is the joblessness rates, or the employment rates, the EPOP rates for prime-age men by metro areas and non-metro areas. And as you can see, whereas in the late 1980s, these things really tracked each other quite closely, for much of the past decade, there's been a wide gap where less skilled people have been less likely to be employed outside of metropolitan areas than inside metropolitan areas. And this is the flip of David Otter's great fact that the urban wage premium has disappeared for the less skilled. It also appears to be true that there are at least jobs of some form for less skilled people in cities, particularly in service areas, whereas people outside of cities, it's harder to imagine the future of their work. This fact I love, this change from the crooked smile to the hockey stick, and I thought there were two things that really puzzled me about it. What caused the wage premium for rural America to disappear during this time period? Why was it there to begin with, and why did it go away? And secondly, why is it that we've gotten this sort of strong convexification? What happened to the wage premium once enjoyed by middle-income cities? That was such a feature of the sort of middle decades of this, and now really is gone. It's just flat until you get to the densest areas. You can see some of that here. You can see this is their densest fifth fact. I'm tempted to spend 5 minutes or so on the January temperature fact, but I will show you that. I thought this was fascinating, this regional fact going down as well. I thought this was quite interesting. And of course, you can see the BA degree fact over there. You can see really the era of Richard Freeman's overeducated American in the mid-1970s really showing up in those middle years. So there was a lot that I wanted to know here, and I think one of the things that's really critical for me to understand this is I need to see both wages and employment changes at the same time. I'm not asking for identification, Chris, just to be clear. I'm just asking to know if it's looking more like labor supply shifts or more like labor demand shifts in different ways. And, I think these are great things to know. This is the heterogeneity of income by density. I understand Chris's eyeballs are better than mine for making sure that this thing has converged over time. I found this much more compelling. And he also shows you the one for counties as well. But you really see in the bottom 85% of counties, really sort of the regional convergence going on. You really see this sort of diminution of differences across space in a really striking way, and then it stops around 2000. And that's compatible with things that Chris Berry and I wrote about 15 years ago on the end of regional convergence in the U.S., which Ganong and Shoag have also shown. This shows 86 to 95, less regional convergence during the early era, but then a flattening out. In terms of the top 5% of counties, this one's going just in exactly the opposite direction. That one's showing the sort of big increase in diversity across areas. And that really is reflecting the enormous heterogeneity in which different cities reacted to the decline of manufacturing. And as such, in some sense, that's sort of the lead-in for what his manufacturing paper is telling us, is that, 1971, two jokers put up a billboard outside of Seattle asking the last person to leave the city to please turn out the lights. Because just as no one could imagine Detroit with a smaller General Motors, no one could imagine Seattle with a smaller Boeing, right? Seattle has, of course, magnificently reinvented itself, primarily because of its education levels, but understanding that heterogeneity is really sort of critical. This is my version of income convergence has stalled. This is 1980 to 2010. If you do anything to correct for the measurement error created income convergence, it really becomes even a slightly positive shift as well. So it really does appear as if this 150-year period in which income growth was faster in poorer places, which Barrow and Sally Martin documented so compellingly in 1992, that this era of income convergence disappeared just as soon as they documented it. And from my perspective, from the not working perspective, right, this is a world of, far from convergence, this is a world of enormous persistence. So this is the not working rate in 2010 and the not working rate in 1980. This coefficient is more than 1. The R-squared is more than 80%. Okay, so just enormous amount of persistence in which places are jobless. So understanding the end of regional convergence seems important to me. Does it reflect the decreasing ability of population to move across space and arbitrage real wage differences? And what is driving increasing heterogeneity of wages among the densest fifth of counties? This is just showing you the decline in migration and geographic sclerosis, and we're seeing this later in a later paper. But there really is a question about to what extent this is individual preferences or the inability to build in high-cost areas. I did want them to do a little bit more about the things that we love about county business patterns, right? So county business patterns has great industrial data, firm sizes. We know about specialization. We know about, this fact that small firms, this is showing that places with lots of little establishments have more employment growth than places with lots of big establishments. These are the same facts done in a variety of different ways. It would be nice for them to use more of this. I mean, maybe that's a third paper, but it seems like such a natural thing. I'll go quickly over their work on the decline in manufacturing. I found it quite striking. I found it quite interesting to sort of see that you move from a world in which manufacturing was declining in urban areas and relocating to non-urban areas to a world in which it was declining everywhere. I think actually the most effective graphs of this are actually not these, but the 74 to 99, where you see New York and Massachusetts declining sharply in manufacturing, but North Carolina and Alabama first rising, then falling strong, and then the next 20 years where Massachusetts, New York, North Carolina, and Alabama, all of them, right, have manufacturing disappearing. And change in manufacturing is strongly associated with the rise in joblessness as well. So this is the initial change in the manufacturing share associated with the rise of these things. And then they also show you this change in clerical work as well. So we have at least two good explanations for why manufacturing employment is vanishing, technology and trade. And a plausible view is in the long run, all local low-skill employment will be in services, and that American export-oriented employment will be overwhelmingly high-skill and urban. That is at least a plausible view of the world. This suggests that the right kind of entrepreneurship, like Uber, will be able to generate jobs for less skilled people in Boston, but what the heck are they going to do in eastern Tennessee? That seems to me like the central question of America's economic geography, and even for American economic employment policy in the 21st century. And don't forget, male joblessness is not some benign leisure choice, right? Male joblessness is misery. It's associated with, opioid deaths, again showing up in this eastern seaboard. It's associated with a large fiscal externality. Federal government expenditures are much higher when men are jobless. It's skip over that. It's associated with misery. There's the income gradient with happiness is just very different from the level of unhappiness associated with prime-age men not working, and particularly true if they're not they're living alone as well. It's not surprising us that a job is more than just an income. It's a sense of purpose in life, and it's a social network that actually keeps you sane. So, just to end on a couple of policy thoughts, regional heterogeneity is not new, and they make this very clear in this paper. But joblessness is a new twist. And if joblessness involves market failures, either Pigouvian externalities, like these fiscal externality, or various Keynesian stuff that I have never understood, then this should lead us to rethink regional policies again. And I think maybe the central divide is, do you actually believe in regional redistribution, right? Using region as a tag to give money, or regional targeting of social policy. And I think the argument is much stronger for the latter than it is for the former. But in any case, there are good reasons to think that America is becoming less fluid geographically than it has been in the past. There's a sclerosis of America's economic geography. And the traditional hope, which was that poor places would become rich by people leaving, doesn't seem to be working, partially because the out-migrants are so much more skilled than the people who leave. And this is what you're seeing in this graph. The 45-degree line is just showing you the gap in less skilled places where the out-migrants are leaving those areas even more denuded of skilled people, which, if you think human capital is the bedrock on which local, individual, and national success rests, makes things even more problematic. Okay, I'll skip over that. Is geographic sclerosis an excuse for revisiting place-based policies? It can be. The less people are likely to move, the more plausible it is to actually give place-based aid of a variety of different forms. The less likely place-based policies are to create pockets of high unemployment and low human capital. But it is still true. Every time I say anything that's not absolutely deeply hostile to anything place-based, Jason Furman will send me an email and tell me that I'm being a jerk and I'm opening the sluice gates for billions of dollars of wasteful infrastructure spending in places where it is inefficient. And that is absolutely true. We should always just wake up each morning and remember Detroit's People Mover monorail, and remember that when you tell government that placemaking is a good reason to spend $1 billion on infrastructure that will never recoup its cost for user fees, just think for a second. Just be worried a little bit about your possibility of making a mistake. I think the case is much stronger for spatial targeting. I have long thought that it is not just unwise, but just crazy to have the same types of housing policies in Boston, San Francisco, Houston, and Detroit, right? These housing markets could not be more different. And it is totally plausible to subsidize housing production in Boston, where the marginal value that consumers put on housing is vastly above the physical cost of construction, right? That gap does not exist in Houston, where the private market does a great job of supplying stuff, and there's no reason to subsidize housing in Detroit, where the valuation is far below construction costs. Consequently, we want different housing policies in different places. There's no reason not to think that you also want different employment policies in different places, right? And that may mean that if you just use a modified Bailey-Chetty formula, that you want to be kinder to people who are jobless in Seattle, Washington, or Boston, right? Because there are fewer people on the margin between working and not working. But in places like West Virginia, where joblessness is more endemic, you want to do more to encourage working. So you may not want to engage in any redistribution, but you may just want to make our policies more pro-work in areas where joblessness is high. And that leads to thinking about whether or not we want to have spatially targeted employment tax credits, vacations from the payroll tax in high jobless areas, or having different disability rules in West Tennessee and Boston. And I would just end by saying I'm so glad that we're doing this topic. It could not be more central and more important, and I'm so grateful to Chris and Ben for giving me the chance to discuss their fascinating paper. Thank you.
Thanks, Ed. All right, so now we have 30 minutes for comments and questions from the audience, and we have a couple of microphones going to be passed around by RAs in each of the aisles there. So go ahead and raise your hand if you want the mic, and please make sure to, before you state your question or your comment, to make sure to tell us who you are.
David Schleicher, Yale Law School. How worried are you about the use of counties as your kind of variable? Counties are systematically not the same in different metropolitan areas. They're much larger in the west as you go west across the country, and that could introduce in your studies of population density some regional changes.
Well, I'll just take a list and we can go around.
Okay, just get a few.
Hi, Brian Stewart from George Washington University. I think one of the things we really want to think about is differences in, say, earnings produced in a place versus earnings received by residents of a place. And so the BEA data, at least from 1969 forward, allow you to make some progress on this. So just your thoughts on that would be useful.
I'll take the question on counties.
Satyendra Naik from India. Our Prime Minister has recently introduced a program of why space is important, 100 smart cities, and government allocated a specific amount for each city to be developed. They are not metro-based, but they are geographically spread in order to develop employment and also private investment. The second aspect of Indian development, which is a large region, is giving tax credit in less developed areas of the country so that it is not market driven in order to allow market to keep investment, but also government spending. So it is both the government spending, smart cities, and tax credit to have a market driven growth within the regions which are less employment generating, where there is more poverty.
Why don't you respond to that? Actually, do you want to respond to that one now? Okay, so
I guess there are some zip code tabulation areas that are very, very, very small compared to the rural ones. We also wanted to consider that, we wanted a unit that would cover the entire United States so that we could do spatial econometrics. And there are problems with converting zip codes into ZICTAs. And there's also the MSAs and CBSAs do not cover the entire country. And then the other thing is we wanted to take a really long-term look, and that was the the definitions of MSAs and CBSAs change over time. The ZICTAs only really started around 2000, and with this county business patterns data, it allows us to go back to the mid-60s. So it was just the best thing.
And I'll take the question about the BEA data, the idea of we should look at earnings produced in a place. I think I actually did, as part of the project, with the little bin scatter plots. I was skeptical. I was like, why is it early on in 1964 that the 1 or 2 percentiles is actually making more, than some of the more dense counties? And I replicated a lot of what I did with the BEA earnings by place data, or the sort of where the earnings were received and sort of compared it to where the people lived. And I got very similar pictures. But I think that there would need to be more robustness checks along those lines for exactly the reason you say for some of the other results in the paper.
I will take on Prime Minister Modi. On one level, I completely cheer for any reorientation of Indian political economy to be supportive of cities, right? The basic structure of Indian, particularly state-level government, is so strongly oriented historically towards rural areas. I mean, primarily because of the voting rules, where voters in rural Maharashtra would often have 10 to 20 times more elected officers per capita than voters in central Mumbai. So the urban reorientation is a great thing. I think the real questions are about the actual delivery of the Smart Cities program, right? So it's the vision of doing something for urban areas is great. I think in terms of my conversation with the Indian government, the problem has been more in sort of on the ground and sort of making it operate. And I think that's very much where these things come down. In terms of tax credits, again, my starting point is always spatial neutrality, right? I always think that the right place to begin with is that the federal government should be spatially neutral towards particular areas. Until you can make a case that there's sort of a compelling externality that is pushing you towards favoring one area or the other, like getting rid of joblessness or reducing joblessness in a level, and you can convince yourself that this tax credit is a reasonably non-distortive way of actually achieving that. So I would generally be wary about locational tax credits, but in the case of Indian history, anything to sort of embrace the urban India of today rather than clinging to a rural vision of the past is devoutly to be wished.
Great, let's take a few more.
I'm Katie Russ, and I love the CBP too. At the same time, when we take manufacturing shares just as a total of the employment recorded for a county in CBP, we really undercount agricultural production. And so we can get a distorted view of manufacturing shares between, especially for some rural areas. And this bites in particular when we're trying to look at patterns over time, because there's been such a big shift, out of the agricultural sector. So I just want to kind of put that note out there for all of us who love CBP.
Catherine, do you have a fix? Do you have a recommendation of what to do about it?
Yeah, so instead you can use the total civilian labor force in the denominator and reweight that way.
Okay. Cool.
Thank you.
Hi, David Otter, MIT. So in the question that Ed asked at the end is, what are all these guys in rural Tennessee going to do? And I think there are two things to think about going forward that sort of, I don't know what they imply, but I think they're important. One is, of course, rising care needs, right? Our population is rising very rapidly. We have a shortage, small cohorts entering the labor market. They're actually highly educated, meaning that they're going to be less inclined to do service work. And of course, our restrictive immigration policies are adding to that. So there's going to be enormous need for care, both actually in the places where male joblessness are high, because that's where there's a lot of elderly citizens. The other factor that sort of bears on the geography of work, and that I don't fully understand, but the death of distance has not occurred for the high skill, right? Cities have become better and better places for high skill, but I would argue it may be occurring much more for the less educated. A lot more work that doesn't need, a lot more mid-skill work no longer needs to be done face-to-face, right? It can be outsourced overseas. It can be done remotely in back office locations. And again, that seems like that presents challenges. Like I think the sort of polarization of employment in cities is quite challenging, but it also presents opportunities. I mean, it may be possible for more opportunities to be moved to places that are not terribly expensive and not extremely highly educated. So in sort of thinking about this conundrum going forward, I do think those are two kind of accelerating forces that will affect policy responses and just the strong undercurrents of demographics.
David Newmark. I have two suggestions, or a suggestion and a question, I guess. The suggestion is when we're looking at those long-term regressions with the CBP data, I kind of wanted to know what's the role of the individual control and what's the role of the location. And of course, when you just do CBP data, you can't sort those out. And obviously, you can't do CPS by county all the way back. Like you can do ACS, doesn't go back very far. But at least, since you're doing sort of long-term, the census years plus the ACS years would let you do that. And I think let you parse out those two things. I think that'd be very interesting. Because there's, there's compositional changes, and there's the manufacturing story you had, for example, is it, being a manufacturing worker or being near manufacturing or being near but not too near manufacturing, like that's driving things. The second thing that strikes me in a lot of this discussion of male joblessness is, to what extent are we getting different male and female responses? I was struck, I don't know if you saw this, a few weeks ago, an article in the New York Times, one of those long Sunday ones, about coal country, right? And what are people doing as the coal jobs disappear? And this is not data, I realize, but every single story was about a wife going back, accessing various kind of programs that gave her access to training in community college and taking on some jobs. And they were care jobs, to David's point, to some extent. There wasn't one story, and it may be because the reporters actually couldn't find anyone, about a male going back, taking a job, lower pay than the coal mines for sure, but nonetheless a job to make up for family and I'm interested to what extent it's the men being resistant to taking the kind of jobs that are out there, or employers not hiring them, to what extent that plays a role in some of this, and how different things look, let's say, for women than men in these places.
Great. You guys want to respond to those?
I would just say on the women versus men, if you look at prime age male or prime age participation in the United States over the last few years, it's remarkable that there's in the U.S. there's been a recovery of prime age participation among women, but much less so among males. And if you work doing macro labor stuff at the Federal Reserve Bank of Boston, you spend a lot of time trying to distinguish trend from cycle in that. And is it the fact that the men's participation for the nation as a whole sort of has flattened out? Is that actually rising relative to a very steep trend downward? I guess this is to say there's a lot, I think, that we don't really understand about how men and women are differentially able to take new opportunities, whether the expansion of the service sector, for example, and I think David has done some work on this, is much better for women because it's just a more natural fit in a way that we don't really understand in economics. So I would say, obviously we didn't do a lot in that paper, but the difference between labor force participation for males and females is certainly a big topic that we're concerned about now nationally at the Fed.
Yeah. So for David, so you're absolutely right. Of course, I mean the dominant industry in declining parts of America is healthcare and social assistance, right? Which stays there when all of the exporters leave because the feds pay for it. That is certainly one plausible thing, is that will be the economic anchor, but that is still kind of a dark anchor, right? I mean, it's not an anchor that's particularly dynamic. It's an anchor that's correlated with future decline. But it's certainly right. You're certainly, I mean, so the death of distance has been bad for some low-end services, but not for others, right? So, anything that involves, actual interpersonal contact and being pleasant and taking care of, lawns and doing stuff like that, those are low-end jobs that can persist. And, if many high-skilled people actually would like to outsource more of the painful things in their life to low-skilled people. That feels to me like the future in many ways, ideally, but I do fear that your upside, which was the sort of death of distance leading to more outsourcing of the middle range jobs, of the office work, that certainly is right currently, but doesn't part of you also think that if it can be outsourced, it can be mechanized? And it's likely if right now it moves to a suburb of Rochester and gets done in an office park, but eventually we figure out either how to do this in India or just as likely that it's a computer simulating a human voice doing it, since we're requiring so little from this. So that's certainly my fear, is that basically any sort of low skill job that's not involving interpersonal contact, that's not involving delivering sort of pleasure in a one-to-one connection, that feels to me like that job just vanishes from the planet at some point in time, because it gets done completely by machines.
All right, a couple more.
So I wanted to come back to this crooked smile idea, and I just wanted to note that when I look at it, there's obviously two findings there, not one, right? You emphasize both of them, and one is the fact that these large places seem to be pulling away from places that are still, as Ed noted, very big, right, in the top 10 percentile or 15th percentile of metropolitan areas, and they're pulling away. Then you also showed the interquartile range that some of the very big places were pulling away from other really big places. And the question becomes whether it's one thing, whether there are certain cities that were well positioned, as Ed has suggested, and it just happens that the well-positioned cities tended to be larger, and there's good reasons to expect that. Or is there actually two things going on? Is there some structural reasons why certain large cities could succeed and certain ones couldn't, and different structural reasons why middle-sized places aren't doing well? And you can even think individual levels of inequality. There's a similar question, right? In the very large places, while rural places have been left behind, in very large places, we've seen substantial growing inequality between the wages low-skilled workers earn and what high-skilled workers in these big, successful places are earning. And again, the question becomes, is this simply a general decline in general increase in the return to skills and a decline in the demand for low-skilled labor, or is there something different about, structurally different about the fortunes of low-skilled people, possibly because of the growing demand for services and one-to-one interaction between low-skilled people who are falling behind in cities and in other places?
Actually, if I could just jump in and answer that, right, I think that's exactly right, that there's a lot more that we could do statistically to sort of tease out all these nonlinearities. And I think that's when we would bring in what's going on in commuting zones, what's going on in metro areas. We wouldn't just use counties at that point. We'd say, all right, what do we get for a different level of aggregation, and then that might help get at that issue. But you're exactly right.
Ed Keene with the Observatory Group. Could the speakers talk about the role of transportation infrastructure, transportation access for airports, highways in explaining the trends that you've been discussing?
think, do you have? Is there a question over here? Yeah, this one.
Yes, it's Brian Bethune with Tufts University. The question you mentioned sort of tangentially, the idea of externalities, and I think that my sense of it, if we just sort of focus on, unemployment among prime age male, that's not going to resonate in terms of thinking about what are the positive policy solutions. So what I'm thinking is there any way to measure these externalities, meaning, higher healthcare costs, higher addiction problems, higher law enforcement, incarceration, followed by recidivism. So those things, if you start to flesh out let's say, the particular burden or cost or externality cost, then you start to build a case that has some credibility.
All right, we'll take one more. Gentleman over here.
I used to work for the FDIC. I'm now retired as regional economist. And of course, I faced as part of my job portraying the individual experiences across New England, which varied, as you point out, greatly. In doing so, I found over time I began to move away from the labor market data, basically, and use more the data from BEA, the statewide data on GDP, which has remarkable amount of detail at the industry level. It only goes back to 2000, admittedly, but it nevertheless is extremely helpful because it changes the nature of the discussion. It basically reveals the individual performances and the dynamic quality, which is basically about technology, the development of technology, and you can then spin the story about global supply. And in the part of what it is, essentially, is a success story. And the success story involves also casting aside a good deal of the industrial structure that had been put in place over a considerable period of time. The remarkable thing about this area that's been able to reinvent itself and go back to some real core values and core capabilities it had way back in the historical period. So it is what I'm talking about is context. I don't question your use of the data, but beyond those data set, there are other data sets that can provide a lot of illumination.
All right, do you want to respond to those?
I'll just say a couple of things. On transportation, I'm not really an expert on sort of, I'll just say this. When we first looked at the manufacturing decline in urban areas in the CBP from 1964 on, I was stunned because, I hate to admit this, but I thought that a lot of the manufacturing had left urban areas in the 1920s. And of course, several people, William Julius Wilson, others had commented on that there was a migration outward in the 60s and the 70s that had particularly negative effects on communities that had worked in those manufacturing jobs. My understanding is that a lot of that was in part due to improved transportation, the container ships and the trucks that would move the containers. You can tell I'm not an expert. So I would not be sort of able to speak so much on the transportation effects, but I do think they probably played a big role in some of the patterns that we saw. On the other part, on using other data, I think you're exactly right. And one of the things that we found sort of along the lines of what you're talking about in New England was that, I think Ed showed this graph, we have it in the paper, we didn't show it, but during the Massachusetts miracle, manufacturing employment was actually declining in Massachusetts as it was in New York. That gets to the issue of what was going on at that time. Were they sort of being pushed out because Massachusetts was such a great place to develop other types of industries, or were there trade shocks or other stuff going on that was hitting manufacturing in Massachusetts relatively intensely? And perhaps going to other data sets and things like that could potentially answer that question.
So, transportation, then talking a second about externalities. The transportation is, of course, deeply powerful in shaping American regional changes. I think the thing to be wary about, though, is thinking that when you see a distressed region, the right thing to do is to throw more transportation at it. I mean, after all, that was one of the big things that the Appalachian Regional Commission did in the 70s and the 80s, with very few perceptible effects on the long-term social problems. And indeed, if any of you are interested in where the cutting edge is on sort of estimating where the biggest economic bang for the buck is in transportation, there's a recent Alan Anarchalakis paper that's terrific that does point out there are huge places for America to invest in infrastructure. Most of the highest return roads are actually in the New York metropolitan area, though. Those are the areas where, in fact, expanding lane miles would be worth a huge amount in their estimates. And it is just so easy to waste billions once you start wrapping sensible transportation investments up in the magic of this can bring Detroit back. So measure the actual economic benefits. Secondly, I want to dispute the premise, but then agree with you. So I want to dispute the premise, which is, in fact, I have never had the slightest problem when discussing with anyone in a policymaking role of arguing that the rise of joblessness in America is an enormously pressing problem. I have never had anyone push back and say, no, that's obviously irrelevant, Ed. Why would you possibly worry about the fact that 26% of men in this county are not employed? Why would that? And so I just think you're just completely wrong on this. And in fact, explaining externalities actually makes things worse, not better. That being said, in terms of the scientific agenda, I am totally in favor of measuring the externalities. We do this, some of my paper with Ben Austin and Larry Summers. We try to measure straight out fiscal externalities and come up with some other numbers along with other sides. And in terms of figuring out what you think an appropriate Pigouvian subsidy for work should be, actually that hinges on what you think the externalities are. I will just give as a tidbit of like a quandary that I've had around externalities are lots of these non-employed men are being paid for by people who are in their larger social network. Right? Parents, more than 30% are living on their parents' couches. To what extent do we actually think about that as being an externality or something that's entirely internalized at the position of making a decision? It's not a trivial answer. So I'll just end with that. Yeah.
All right, I think we do have time for one more round of questions. Two over here.
Hi, Beth Mattingly. It looks to me like you classified county density each year. So you might have some fluctuation from year to year. And I wonder if you've thought about those counties that move between categories and some of them, the most flourishing, may rise above their category and some of those that are most troubled may fall lower in population density. So I'm curious your thoughts on that.
Actually, let me jump in on that real quickly. Yes, we did. And actually, we spent yesterday taking out all of the slides that had, well, if you do it this way and this year and that way this year, and they were, and you can ask Ben, it was painful for me to do that, but yes, we have.
There's like 30 pages in the appendix that does that, right, Chris? I mean, it's mind-boggling.
Yes, there is. But on a serious note, one of the reasons we wanted to do sort of a basic density thing is because the definitions of rural change over time, and we're afraid of getting caught up in, okay, this is what's happening to suburbia, this is what's happening to rural America, and then trying to figure out how to sort of maintain some constancy over time. So the idea of doing density, sort of the density flat, is they're fairly stable. We could sort of analyze things and do some robustness checks. Miraculously, for the sort of suburbanization stuff that we did, it really doesn't matter at all. Whereas if we were doing population shares or other types of things, that it does. So that's a long way of saying, yes, we did worry about it.
Jeff Zabel, Tufts University. Ed, you've been convinced to run for president in 2024. President Glazer, doesn't that sound great?
It sounds terrifying.
So you have to pitch to the Trump voters. Right, these are the voters in these areas that have lost manufacturing with high unemployment. Right, what's your pitch to them in terms of bringing back jobs? Because targeting employment tax credits only work if there's more employment. So how do you convince them? What are your policies to bring jobs back to these jobless areas?
You are only reminding me of why it is that I have got no business being anywhere near politics, Jeff. It's certainly right, and it hits the central quandary. So as an economist, I believe that if we do more to encourage work and encourage job creation, and remember, you can think about the employment tax credit as being implemented at the firm level as well. You can imagine getting rid of the payroll, the part of the payroll tax that firms pay workers, which it should be irrelevant in our models if there's no downward constraint on wages. If there is a downward constraint on wages, then it will actually matter. I would wrap it up with some getting rid of the bad government policies that have, prevented job creation in your obviously worthy and highly productive area, right? I mean, that's I think where I would go with this. But at some basic level, it is a leap of trust that if we actually generate incentives for job creation, the jobs will actually be created. And I don't know, because I can envision, we can see what the jobs would be in greater Boston, right? I co-chaired a committee to try and create, with John Barrows, to try and create an entrepreneurship zone in a high poverty area in Boston. And it's easy to think of the thousands of things that lower income kids could do in Boston that would actually bring them some form of a brighter future, whether or not working in service industries or being part of the Boston's export machine. But I have a lot more trouble saying these are the jobs that will come back. And in part, that's always the problem in pitching economic ideas which lead to more innovation, is you don't know what it will mean to innovate. And that's in some sense why backward-looking policies, why protectionism are so politically appealing, because everyone knows what jobs you're trying to protect, but no one knows what happens if you get rid of those things and try to create a world in which new jobs will be created. No one knows what entrepreneurship will come about. And so I guess I would say something like not giving up on the spirit of American entrepreneurship, not giving up on the ability of your region to come up with new ideas as it once did that changed the world and that changed the economic future of America. So I would try something like that.
All right. All right, anybody else?
That, finally, if you go to space, I remember Bertil Ohlin. It is not international trade, it is inter-regional trade. And every region has its factor endowments which are not homogenized. So we are homogenizing a lot of factors and endowments and then leaving it to the market economy. I mean, it's become now, okay, the overall growth is okay, but now there is a spatial problem. So it is the responsibility of the counties and the states to find out and to ascertain the regional endowments which are comparative endowments, which are comparative cost beneficial and which can generate income. And once you handhold, the private investment will come. I mean, finally, it's an idea, but it is to be supported at the county and state level. And then the market will come. And market cannot always go to opportunities everywhere. Market will go where the rates of return are highest and not the otherwise. So that's why now that we have reached a stage in our economic growth and a cycle, especially the developed economies like the US and others, there has to be, in order to get over this problem of employment, there has to be heterogenizing the factor endowments and generating employment and income in small places which has its own individuality.
So I'm a big supporter of eliminating the barriers to interregional trade in India. So I certainly support the Modi government's work on that greatly. Yeah.
All right, we'll go ahead and take a break. And as a reminder, there'll be coffee out here, restrooms back there, and we'll reconvene or kick off the next section at 10:45. We'll have 30 minutes for that, and this is a paper to be presented by Jay Shambaugh, and his co-author Catherine Russ is up here on the podium as well, and the discussant will be David Otter. So with that, I'll hand it over to you, Jay.
Thanks very much. I'm just starting a timer. I could talk about this all day. I really want to sincerely thank the organizers of this conference for asking us to work on this paper for it. It's a fantastic lineup of people, and I'm really honored to be a part of it. What we want to talk about today is a paper on education and unequal regional labor market outcomes. And one of the reasons I was so happy to be on this program, especially after seeing who else was on it, was that many of the other people on the program have been really influential in what I've been thinking about and the puzzles I've had in my head for the last 5 years. And I mentioned to David beforehand, in some sense it has summed up for me is how can a world where Blanchard and Katz's results exist that you get Otter, Dorn, and Hansen's? And I'll explain what I mean by that kind of as we go along. So the paper we're going to talk about an end to convergence. There'll be some pictures that actually look not unlike some that Ed put up, and I'm guessing other people will put up similar ones over the course of the next couple days. But I want to talk in particular about a growing persistence in regional labor market outcomes. There we go. And then talk a bit about trade shocks and how trade shocks might be part of what's going on here. And then talk a little bit about policy at the end. So one thing that's important to note is this paper is really kind of pulling at a lot from two different previous papers. So one with co-authors at the Hamilton Project, Ryan Nunn and Jana Parsons, in a paper we had there called The Geography of Prosperity. And then a lot in particular of the back half of the paper is work Katie and I did with co-authors at UC Davis, Catherine Erickson and Fei Zhu. So I just want to be clear, we're borrowing a lot from our co-authors in what we're doing here. The conference here title is A House Divided. The House has always been divided, and I think that was mentioned last time, and I think it's just really important to emphasize over and over how big these regional gaps have been and how they, in fact, used to be bigger. And so it's not like it's something new that we have regional gaps across places. They're huge today, but they actually used to be bigger. You can look at a whole set of literature talking about this convergence over time. We cite one here, Michener and McLean, showing you have this huge convergence over 100 years, and a lot of it coming from increases in labor productivity in the places that used to be much, much poorer. But then, as a number of people in this room have pointed out, that seemed to stop at a certain point. Sometime around 1980, that stopped. And so just looking at this, one way you can visualize this is looking at per capita incomes of places, different regions, expressing them as a share of the national income total. And so you can see the South down here at 50% of the national total at one point, when you had other places that were well above the national. So you had gaps almost 2.5 times income gaps across regions, and these things just converged in a huge amount over the next chunk of time. Some of that may have been policy. We electrified regions that didn't have electricity, things like this, but a lot more of it just seemed to be the general course of what the economy was doing. But then sometime around 1980, this seems to stop, and we get this, if anything, slight divergence opening up, where you start to see places like New England, clearly the Boston Fed has done its job, kind of taking off back again away from the rest of the country. And you can even see at the end there the Southeast starting to dip back away in the wrong direction again. And so we've got this big convergence. You can look at it here in terms of income, but you could look at this in any number of different statistics. I agree with Ed that the kind of the prime age employment rates or participation rates are really important. If you look at the top 20% of counties today, prime age employment rates are about 15 percentage points or 16 percentage points higher than what it is in the lowest 20% of counties. In the Great Recession, nationally, that fell about 4 percentage points. So it's almost like they've had 3 or 4 Great Recession shocks in the lowest counties relative to the top. And we think what we did kind of as policymakers trying to deal with the Great Recession, it does feel like a lot should be done to deal with the lack of employment in some places. Here's another way to see that convergence ending. This is looking at counties, and so this is median household income in counties. From the 1960 to 1980 picture looks like a perfect picture of what you think convergence should be. The counties that were the poorest in 1960 were growing fastest over the next 20 years. The counties that were richest in 1960 were growing slowest. So you have this big convergence happening. You flash forward to 1980 to 2016, and it's basically a flat line. If you look, the red regression line there has a very slight downward tilt, but if you actually run it with a weighted regression by population, it's dead flat. And so we just don't have convergence anymore in terms of income. You could look at this more broadly, and we did at the Hamilton Project, where you kind of pull together a whole bunch of things, pull together employment rates and household income and poverty and life expectancy, and kind of put them all together with factor analysis and ask how were counties doing at different points in time. And if you break them up by quintiles, the really depressing thing is if you weren't doing well in 1980, you're still not doing well today. 71% of counties that were in the lowest quintile are still in the lowest quintile, and in fact 92% are in one of the 2 lowest quintiles. And the exact opposite happens in that lower right. If you were in the top, you're still in the top, or quite likely, and at least you're probably in one of the top 2. And so what you're seeing is, again, so it's not just income. Across a range of measures, if you pull them together, you're seeing a real stagnation in regional gaps. Places that are doing well stay doing well, places that aren't. So there's just very little upward mobility for counties. So what I want to turn to then is think about the persistence of labor market shocks. And sometimes economists, you see them complain that you can't publish null results. This figure suggests otherwise, because I think it's one of the more influential figures. This is our recreation of what was in Blanchard and Katz, which is they were showing from that what your unemployment rate was in 1975 just had 0 predictive power for what it was in 1985. And so you just see you don't get. So this would say, we don't worry about regional shocks because they go away, right? And I should be clear, there was a lot more in that paper than that. There was some really fantastic work showing how much mobility does versus how much employment does and things like that. But this was, I think, really influential to a lot of people thinking about the United States being different than, say, Europe in terms of the way regional market outcomes, labor market outcomes evolve. And other people have done a lot of work. Bound and Holzer had a nice paper looking at this for the 80s overall. We started to look at this again, and this is where I was saying, well, if this is true, then how do you get these Otterdoorn and Hansen results that the China shock has really persistent labor market outcomes? And so we just started to roll this forward. And conveniently, so 76 is where this data set can start consistently forward, so we just use 76 to 86. Conveniently, if you keep using the 6s, you don't run into a recession, so they make a nice set of decade jumps to do. But if you flash forward to look 86 to 96, all of a sudden there's a bit of a slope there. It's not a cloud anymore. And then 96 to 06, again, you start to see something. And if you squint or if you read the paper, you can start to see there's actually a non-zero coefficient there, and the R squared start to get up into the 0.2 range instead of the 0 range. And so suddenly you're starting to see, actually, knowing what the unemployment rate was a decade ago tells you something about what the unemployment rate is today. It's no longer kind of washing away. If you flash forward to the most recent 10-year period we've got here, now actually that slope is around 0.6. If you knew what the unemployment rate was in 2006, you've got a pretty good guess what it was in 2016. Shockingly, if you just run this over 30 years from 86 to 2016, you still have an R squared around 0.3 and a slope of around 0.3. The unemployment rate shocks aren't going away, or I shouldn't say shocks, the unemployment levels aren't kind of converging back to the same level nationally, the way they were prior. And I should mention, there's a great paper by Dow, Forseri, and Lugani that looks at a whole range of the results in that Blanchard and Katz paper, kind of rolling them forward, that I highly recommend there. So one of the things we were trying to think about, and I just did want to mention, this is true at the county level too. So if you're looking from 96 to 06 or 06 to 16 at the county level, you see this, you get a fairly strong pattern of the unemployment rates get stuck once they're somewhere. And if you are reading the top there, you can see the persistence got stronger in the second of those two figures. So what happened? So on the one hand, you can talk about mobility being down. I'm not going to talk about it too much because there are too many people who know a lot more about it than I do in this room. And I know there's a whole session on it later in this conference. And so in particular, we know that for workers with lower levels of education, mobility is not as high. We also know that there are a whole range of stories about barriers to mobility. So is it that we won't build housing in the booming areas anymore, kind of a Ganong and Shoag story, and so you just workers can't move to the booming places? Or is it more of a story that you don't have as much incentive to move anymore, kind of thinking of David Otter's AEA lecture from past in January, thinking that you just don't have the returns if you're not a high education worker to move to these expensive cities anymore. So there are a lot of pieces around this and other stories that might make you think part of what's going on centers around education, right? So Bound and Holzer's results, when they were looking at that kind of Blanchard and Katz story, one of the things they were finding was that workers with less education are less likely to move after a negative labor market shock. And so you might worry that what's going on is low education places, something is different there. Again, with the Otter 2019 work on less of a premium, so they have less of a reason to move somewhere else. We've also got the kind of second paper I was mentioning, this paper draws on, the paper with Erickson et al., that the China shock actually hit areas with less education and it hit them harder. So again, you might think part of what's going on, maybe the persistence is just in these low education areas, and Bloom et al. Have a paper on the China shock showing there was a quicker pivot after it for the high education places. A lot of how I've thought about it comes back to one of my favorite papers I've ever seen, which is by John Skinner and Doug Steger, that talk about great scatter plots. It'll show you that the same places always pick up innovations. It's not that they're doing them, but the same places that used hybrid wheat first also used beta blocker technology for heart attacks first. And so it's just the same places grab the best innovation that comes out and employ them over and over and over and over. And so, and part of that connects back to education. So it made us think that's got to be the story. So we decide just to look at the persistence across education, and there's no difference. And we did this with regressions, with interaction terms and all that. There's nothing there. It's, if you look at the highest quintile of college education and ask what the persistence in those places are, and you look at the lowest quintile of college education and look there, they have the same slope, the same R-squareds. If anything, there's a little bit more persistence in the places that have high high school completion relative to low high school completion. And so it's not the case that actually the persistence of unemployment is just in the lower education areas, which got us, frankly, very curious as to what was going on. And one hint you can start to see is when you look just at the x-axis here, right? And you see that those high education places, they're all clustered at low levels of unemployment rates, and the lower education places have a lot more places out there in the high unemployment rates. And so it seems like they're both persistent in some way, but they're persistent differently. And so we thought about this some, and then I think it was Katie who had the idea that we should be looking at transition matrices to think through this. And so that's what we tried to do. And so what I'm showing here is if you imagine that 5x5 grid I showed you before, we're just going to focus on that 1, 1, and 5, 5 cell. So if you were in kind of a bad outcome at first, do you stay there? Or if you were in a good outcome at first, do you stay there? And if you look at all counties, in the first column here is 1970 to 80, and the next is 1970 to 90. And what you see is about half the counties stay in the worst unemployment outcome or in the best unemployment outcome. If we start to split that, though, by education groups, and so this first set of rows are for the higher education places or places with a population with more education, and the bottom rows there are for the places with populations with a lower level of education. And what you get is that you start to see that, in particular from 1970 to 90, 70 to 80, there's a bit more mixing up going on. And I think in some sense that's what you were seeing in the Blanchard and Katz results as well. But what you start to see is that the high education places, if they are in a good unemployment rate state, they stay there. They are highly persistent. If they're in a high unemployment rate bin, though, they don't necessarily stay there. They're actually reasonably likely to bounce out of that state. And the exact opposite is true for the low education places. For the lower education places, if you are in a bad state, you're staying there. You don't get out. If for something good happens and you have a low unemployment rate, you don't necessarily keep that low unemployment rate. And so that's the idea, is that the average persistence for these different types of places is actually similar, but the persistence is incredibly different. One gets persistence for a good outcome, the other gets persistence for a bad outcome. You can roll this forward to the 96 to 16 groups, and you get a similar type of story where the higher education places are more likely to stick in good outcomes, and the lower education places are more likely to stick once in a bad outcome. So that persistence has a different flavor to it. You can, I think this figure on the left here is the one that really stuck with me, which is this is asking, if we again take those kind of four groups, the high education being either you have a lot of college graduates or you have a good high school graduation rate, low education, the opposite. And we ask in this figure on the left, how likely were you to be in the counties, the quintile of the lowest unemployment rate? So were you in the good unemployment rate state? And this is, the bins don't change here. This is for the groups based on their education in 1970. In 1970, it's like, well, you're all around 20%, which is the unconditional odds, right? You're all, it's just, are you in the lowest quintile? Well, 20% chance that you're in any quintile in some sense. Over time, though, this divides really, really sharply. And you start to see that the lowest high school dropout rates start to have a 40% chance of being in that really good state. But the yellow line is the incredibly depressing one. That's the places with high school dropout rates. Fewer than 5% of them are in the kind of good unemployment rate state by the end of the sample. You're just, if you have a lot of non-graduates from high school, you're just not in a good employment market. It's just, that's how it's divided itself. And that didn't used to be true as starkly. If you instead ask how likely are you to be kind of in the bad state, you see a similar division. The divergence isn't quite as stark because they started already a little bit further apart. But what we're seeing is, in some sense, while in those income statistics we saw kind of a flattening out, maybe a hint of a little more divergence, here you can really see the greater divergence showing up in how places with different levels of education are reacting to, are getting stuck in different labor market outcomes. So what I want to then think about then is how trade shocks might be playing a role here. So first of all, I should just state that almost certainly part of what this story is a story of skill-biased technological change, that technology that is augmenting the labor returns for high skill or higher education people, and then also perhaps either reducing or even replacing labor for low skill. Then if that happens, then you're going to see patterns like this, and I think that makes a lot of sense. We make an argument in the paper with Erickson and co-authors that there's another interesting part of the story, maybe the way trade shocks are hitting the United States, and that it's a different type of trade shocks than we used to see. And we motivate this a little bit thinking about the product cycle, and we actually borrow from Paul Krugman's formulation of that in his 1979 paper. And the model's an international trade model, and it's thinking about you've got places that are higher education, they generate innovations and new products and manufacture them for a little while, but then over time those products become more routine in their manufacturing, and as they do so, then you shift them over to lower education, lower wage places. And the story is you can see the exact same thing happening in the United States. You get the same product cycle playing out regionally within the United States. And that you get, in some sense, a shift. If you've had that shift take place over time, though, it means that when manufacturing trade shocks hit the United States, they're going to be hitting different places today than they used to hit. So one way you can see this, if you just look at manufacturing and look at what does manufacturing correlate with in terms of what different commuting zones look like. It used to be true, say in 1910, that if you had a lot of manufacturing, then you were a high patent place and you were a high education place. Rolling forward to 1960, that's still true to some extent, but not as true on the education front. And by 1990, there's a lot less strong correlation with patent activity. But one of the things is manufacturing overall is a complicated set of industries, right? There are high-tech, new product cycle kind of industries mixed in with the late stage product cycle. And so one of the goals then is to think about, well, how could we identify the late stage products? And you can't just identify them based on them being produced in the low education areas, because then you've just kind of assumed your answer. And so what we do is we lean on our discussant, and we use the Otto Dorn and Hansen trade shock. And we say, if China was exporting goods to rich countries in 1990, those were late stage products. And we instead look to see how those products evolved over time. And what you see is that in 1990, the China shock industries were incredibly high education, high patent places. Over time, they became less so, and then by 1990, though, it's entirely reversed, that the places manufacturing the goods that were hit by the China shock were highly negatively correlated with education at that point. If you look at this in pictures, just because they're fun, the red are the places that are highly exposed to the China shock if it had happened in the decade I'm showing you. So in 1910, it is the high education, high innovation places of the United States. If you move forward, in 1960, that's still largely true, although you see that activity has started to move down some. By 1980, it has really moved. And by 1990, you see it's no longer a Massachusetts phenomenon. It's no longer a Great Lakes manufacturing phenomenon. It's now moved all the way down here. This is why if you say the China shock hit the Rust Belt, David will always correct you and say, no, it didn't. It hit down there. And so what we're saying is that when the China shock hit, it's a very different trade shock than we used to get. It's not hitting the high education places anymore. If you instead look at the Japan shock, and so we recreated in the paper the parallel to the China shock, but for Japan's exports to the United States, they never moved to the low education places. So when the Japan shock is hitting, it's hitting higher education places, places that are more likely to escape a negative shock than the places that got hit harder by the China shock. And I should note here, since I didn't on the earlier slide, what we're doing in this paper, that other paper, is in no way kind of trying to overturn the Otterdahl and Hansen results. What we're showing is that they're hitting a particular type of places. Otterdahl and Hansen have all the right controls in the paper. It doesn't change the results. It's just saying if we look at who is getting hit, it's a particular type of place. So the implications here is I think you can think of the China shock in some sense as almost short-circuiting the domestic product cycle. When things should have been moving to the lower education areas and providing jobs there for a long time, they were immediately getting hit by the China shock. So the 1975 to 85 trade shocks just look a little different. They're hitting a different type of place. I should be clear, it doesn't mean it was painless for those places, but it means they were better off to start with and had better capacity to innovate a way to move to different types of industries, whereas the China shock is getting concentrated on places that are already getting hit by technology shocks that are tough for them to deal with. And so when you kind of combine the technology shocks with some of the institutional shifts in mobility and migration, these trade shocks are really helping entrench some of the regional gaps that we see across the country. So what does this mean? I think you can argue, it argues for a renaissance in place-based policies. I think it's important to note, and this room probably knows more than most, that people have been working on these for a long time. Different groups like Brookings Metro or Upjohn have been doing really interesting work in this area for a long time, so it's not new, but I do think it's getting more attention, and I think it's getting more attention in part because of the politics, people trying to understand kind of Trump country in some sense, although I would emphasize that I think in all the work I've seen, it's not just Trump country, right? The Bronx struggles too, Gary, Indiana struggles too. It's not all kind of rural places or smaller cities. But there's really a good argument for more place-based policies in some directions. To jump to the bottom first, and this is in some sense echoing some of the things Ed said, there are a lot of lessons we can get from the past of really bad policies that we shouldn't try. You can't just increase the supply of higher education because people move. You can't just subsidize capital because then the benefits don't necessarily stick in the places, and you don't necessarily help the people in those struggling places. And the gaming and defining areas is a huge problem, and we've seen that, I think, in the most recent place-based policy in the tax code. But there are things you can do. On the one hand, you could try to help with mobility, but that's not a sufficient answer, I think, to say just move, because it's not relevant to everybody. I think, and this echoes some of the work in Austin Glazer and Summers, David Newmark has a terrific policy proposal for the Hamilton Project that I think he'll talk about some later, about ways you could subsidize labor in high poverty places. Tim Bardick has talked about this too. I think the idea of subsidizing labor in these places with incredibly low levels of labor participation is important. In some sense, what you're trying to do is figure out a way to increase labor demand in these areas. It can't just be about the supply of education. That's an important piece probably, is fixing, especially getting people through high school and some level of training, but it's probably not the only thing. You could do better connectivity either to universities or to the kind of higher growth regions, whether it's through infrastructure or broadband or programs like manufacturing extension partnerships. There are immigration reforms that EIG has talked about of trying to get more immigration into those types of places. But I think there are actually a lot of things we can do other than just build 2 billion very, very cost-benefit negative projects in these areas that would actually increase demand for labor and help these places. And I think seeing the both end of convergence on the one hand and growing divergence in labor market outcomes is in some ways a good argument of why we should be really pushing forward to do so. So just in conclusion, the gaps across regions have become very, very persistent, both in levels of income, but also in unemployment rates. So it's not just income levels that are there. We're seeing it on unemployment rates, as Austin Glazer and Summers have pointed out. We're seeing it in labor force participation rates as well. But these economic outcomes are really dividing on educational lines far more strongly than they used to, giving us, I think, a real challenge as policymakers to think of what should be done there, and that in addition to thinking about the shifting valuation of skill and different education levels, I do think thinking how trade shocks and different types of shocks are hitting different types of areas is important for us to think about as economists and policymakers. So I think that's where I'll stop. I'm out of time. So thank you again.
Thank you.
Great. Thank you. It's a pleasure to be here. This is just an awesome conference. What a great lineup of papers and discussants, present company accepted, and it is a pleasure to discuss this work. And let me sort of just frame it. I think the big question this paper is asking, and the line of work that these authors have been doing is understanding the relationship between shocks and persistence, and why aren't shocks dissipating across space? Why are they sticking around? And I think, and focusing on the China shock in particular, I think the question they're asking, and a question that I was asking myself as I was reflecting on these comments is, was there something special about the China shock that just made it more durable, more shocking? Or is something special about the places that were hit by it? And I think that's the question they're asking. I think it's the right question to ask. And let me say, I like this question much more than the earlier question that many authors asked, which was the China shock paper wrong? You know, I think that literature has played out. So I'm happy to see this new literature about, now that, how do we interpret it? And I have to say that when Gordon Hanson, David Dorn, and I did that project, we were very much informed also by the expectation that U.S. regional labor markets are very fluid. And so we were confident that we had a good identification strategy for finding the impacts of trade on local manufacturing. Of course, manufacturing had to decline given the massive increase in imports of China. The question was, how would that play out? Our expectation was that it would play out pretty smoothly. So we were quite stunned by what we found. It was not consistent with our priors. We spent a long time kind of target hardening the paper before we even released it, because we thought it was so inconsistent with our priors. But I think I think the evidence suggests that really something important happened, and it had lasting effects. So let me, my remarks, I'm going to say 5 things. First, I just want to put up the figures again about the persistence of unemployment, because they are so startling. Then I want to talk about the decline of U.S. manufacturing, put that in a little bit of context. Then I want to show you some evidence on just how concentrated, how durable these impacts were along a variety of margins. Then I want to talk about the characteristics of China-shocked places. And by the way, I'm going to be remixing things that they said, that Ed said. I hopefully will display them in a way that's different and informative, but I'm not going to fundamentally disagree. And then I want to talk about the relationship between the China shock and the sort of changing geography of work and occupation. So as a starting point, just this figure alone tells a lot, that there was no predictability between the unemployment rate in a state in 1976 and in a decade later. But that's not true if you look over the subsequent 3 decades, so 86 to 96, 96 to 2006, 2006 to 2016, and over. So we have persistence bigly, as some would say, and so that itself is a surprise. That alone is not something that we grew up believing, and it's not that the old facts were incorrect; they just aren't the same as the current facts.
Let's talk now about the decline of U.S. manufacturing. So it's a truism that the share of U.S. employment manufacturing has been in long decline. So here I'm actually dividing, as was suggested, by overall employment, not just non-agricultural employment, and that affects these trends. So if you include agriculture, U.S. manufacturing employment was never above 27% of all employment, and then it's in a long decline, but you can see that it's a pretty smooth decline. And you kind of have to squint to see the China shock there. You can sort of see, if you look around 2000, it seems like the rate of decline kind of accelerates, but it's not startling. So now let me just do this, take away the denominator and just give you the count of jobs. So this is the number of people working in U.S. manufacturing. And you can see that, it's not at a high in the end of the Second World War. In fact, it reaches its peak in 1979. Then it enters a long, slow decline. So manufacturing loses 2 million jobs over the next 20 years. And then between 1999 and 2007, it falls by 20%. So it falls by almost 4 million jobs. And then between 2007 2010, it falls by another couple million jobs. So in net, there's a 1/3 decline in the number of people working in U.S. manufacturing in just that 11-year period. Now, the first 7 years of that, or 8 years of that, is the period of extremely rapid rise of Chinese imports following China's accession to WTO. The next few years, of course, is a recession. That's not the China shock. But I do think this figure is helpful because when people say, well, manufacturing has been in decline for a long time, it's technology, you can say, remind me of the great innovation in 1999 that eliminated 20% of manufacturing jobs. There is not one, right? That was clearly a trade-induced phenomenon. Eventually, those jobs would have been automated or shipped offshore, but it just wouldn't have happened so fast. So as Jay said, this really accelerated a process. So just to remind you of how pronounced those impacts were, here I'm just going to put some figures from the work that David and Gordon and I have done in various papers. So the first thing to remember, of course, is just how geographically concentrated these shocks were. And of course, manufacturing is always geographically concentrated. It's not evenly spread across space, and it's more than just manufacturing is concentrated, but the set of things done in places is highly concentrated. So southern manufacturing does not look like northern manufacturing, and the areas that were most impacted by China trade were furniture and fixtures, games, toys, and children's vehicles, sporting and athletic goods, electronic components, plastics, motor vehicle parts and assembly, electronic computer assembly. So these were labor-intensive production in which China gained very rapid comparative advantage. And so this was not the Rust Belt manufacturing. In fact, you could say this was below the belt. This was all southern manufacturing, and it was it was lower paid. It was more labor intensive. It was less capital intensive. It was less skill intensive. This just shows you some ways of measuring the consequences for various outcomes, some within the labor market, some not. So this shows you the impact of a kind of a one standard deviation trade shock, or actually this is the interquartile range, the P50, P75 minus P25, on annual earnings of men and women. So what you can see very clearly is the effect was larger on men's earnings, particularly below the median. And so that's important. There was a lot of low education, relatively high wage manufacturing work. And so when that declined, it was particularly felt by men towards the lower quartiles of the earnings distribution, although relatively high earnings for their levels of education. You can see this more comprehensively. This just shows you impact on male and female earnings by percentile. You can see, looking at the blue relative to the red line on the left, the effect is larger for men across the board. And this does have the effect actually of compressing the male-female annual earnings gap. So it causes convergence by lowering men's relative to women's wages when men's wages are higher at every percentile just about. And that's important because in thinking about some of the kind of non-labor market consequences that played out, some of them have to do, we think, with gender disparities in earnings. So one in particular is marital status. There was a sharp decline in the fraction of young adults, 18 to 39, who were currently married. not primarily stemming from divorce, but from an increase in non-entry into marriage. And similarly, a decline in cohabitation, either living with spouses or living with partners. And let me say, this is actually, it's extremely Beckerian. And in fact, if our paper called When Work Disappears in the AR Insights looks at shocks by gender to earnings, and what you find is declines in male earnings holding women's earnings constant reduce marriage, declines in women's earnings holding men's earnings constant increase marriage, and similarly for fertility. So if, the sort of notion of specialization being a kind of a spur to marriage is really affirmed, and it's the relatives that matter, not just the levels. This, you could argue, and I think something you see very clearly when you look in the data, is that areas, southern manufacturing intensive areas, were places where men had relatively low educated men, had relatively high earnings levels, and were relatively likely to be married. Manufacturing was the kind of economic foundation of a particular set of social organizational, expectations, and the elimination of that foundation had very large social effects. That's not to say that those were the right form of social organization, but that it was kind of foundational to how work and family life was organized. You see this in children's outcomes. So fertility falls, but the fraction of children born out of wedlock rises, and the fraction of children living in poverty increases, and the fraction of children living with married or even two-parent households declines. So the effects are felt, far beyond earnings, and even some evidence of a rise in premature mortality, especially associated with declines in male earnings. And a substantial chunk of that, although not all of it, comes from drug and alcohol poisoning, a much more common form of death among men than women. Surprisingly, we do find an effect on suicides among young women. These are all adults aged 20 to 39. We're looking at excess mortality over a 10-year accumulated period per 100,000 adults. These are not enormous numbers, of course, thankfully, but you should think of them as kind of the extreme margin of a broader phenomenon of despair that Ed was highlighting in his comments. So, thankfully, only a very small percentage of people who abuse drugs and alcohol, suffer fatal consequences. But that you should think of that as indicative of a lot more, abuse going on. Okay, so that sort of, I hope, sets the context of just how consequential this was. So now let me talk about China shock places. So here's how I'm going to do that. So what I've done here is I've lined up commuting zones by their percentile in the 1990 to 2007 China shock distribution. These are China shock as we measured in ADH 2013. This is the growth of the exogenous component of growth of imports per 1,000 workers. And so the percentile thing just linearizes a bit. So at the upper quantiles, that's something like $6,000 or $7,000 per working age adult. At the lower quintiles, it's close to a couple $100. And this is the the effect of, these are imports predicted due to China's rising comparative advantage, projected into your local labor market as a function of what industries you have. So it's not it's not how many Walmarts you have and what you'd be buying. It's what you what we're producing that competes with those imports. So that's the tool I'm going to use, and now I'm going to just display a bunch of characteristics of places according to their China shock percentile. Okay, so this shows you the fraction of employment. This is employment including over agriculture as well as non-agricultural employment in manufacturing as a function of China shock exposure looking over 1950 to 2015. So the first thing to note, so the places that are going to be most exposed are on the right-hand side, least exposed on the left-hand side. And what you can see is in 1950, the places that would experience the largest China shock were not nearly as manufacturing intensive as the places to the left of them. And that's because the places to the left were actually, those would have been the upper Midwest, right? Those would have been the not yet rusting belt. And then if you look in 1970, you can see that relationship steepens. What's happening? Well, you could argue that the U.S. South was outsourcing to China before China was available, right? U.S. manufacturing taking advantage of low wages, taking advantage of limited union threat or no union threat, was moving manufacturing south. And you can see that in 1970, you can see that in 1980. If you look between 1980 and 1990, you see this line start to get shallower, meaning there's some decline. And now I'm going to add 2000, 2007, 2015, and this rapid rotation rightward reflects the decline of manufacturing employment in places that were exposed to the shock, right? So there's an arc here of manufacturing moving into those places between 1950 and 1980, and then it kind of stabilizing 80 to 90, okay, and then rapidly declining. Okay, this just shows you the changes in that. So this is the same x-axis, but these are the changes in manufacturing intensity, and you can see between 1950-70, 1970-80 that places that are going to be China shocked have rising manufacturing employment, and then between 80 and 90 they already start to decline, and then very rapid declines thereafter. So this is just one way of seeing how dramatic this was. The other thing to note is that these places that were going to be exposed to the China shock, or consistent with their work, were less educated, right? So this is the share of adults with high school or lower education, and these places were less educated in 1950, in 1970, in 2017, in 2015, and so that's important to know. So manufacturing is moving to less educated places, but interestingly, and I think it's a really telling figure, if you look at wage growth across decades, so 50 to 70, everyone's wages grow, no surprise there. 70 to 80, pretty stable. In 80 to 90, these are low education areas that have relatively rapid, strong wage growth, and that's not what you would expect, right? Given the rising return to education this period, you would have thought, well, we should have predicted them to have relatively slow wage growth. The reason they don't is because manufacturing is moving into those locations and providing relatively high wage jobs for relatively less educated workers. And then, of course, in 1990, 2000, that robust wage growth goes away, and then after that, it's falling. Okay, finally, you see a similar pattern with employment. Employment population rises in these areas, going to be China shocked in the 50 through 80, 90 period, and then falls really rapidly thereafter. So it's important to understand that there's you should think of this as kind of not things were stable and then there was a shock, but there was this robust growth of manufacturing movement into the South, and then it was rapidly eroded. So this was a kind of a multi-period story. Okay, so now I just want to relate this more broadly to the change in geography of work. So many of you have seen variants of this picture showing you the kind of polarization of employment across occupations. The left-hand side being services, food service, cleaning, security, home health aides, transportation, repair. The middle being production, office clerical, administrative support, and sales, and the upper part being professional, technical, and managerial. Important to understand that this polarization really reflects two different things. For people with high school and lower education, it reflects the movement out of middle skill production and clerical jobs and into services. For people with higher levels of education, it also reflects the reduction in the middle, but a movement primarily rightward, upward, and especially among women, into professional, technical, and managerial work. So really this polarization story is about a hollowing out of opportunities for non-college workers. This phenomenon has also not played out evenly across space. So these figures are now arrayed by population density of commuting zones, and you can see that denser places have become much, much more educated over the last 6 decades. And as I emphasized, the places that were most exposed to trade were less educated. As this has happened, as those high density places have become much more educated, the set of jobs done by the less educated has changed very rapidly. So you can see if you look in 1970 that non-college workers were overrepresented in middle skill work in the 1970s in high density places. That's what that upward slope means. If I add the 1980s, you see a little bit of rotation. Add the 90s, you see more. Add the 2000s, a little bit more, and then by 2015, it's gone. So what's happened here is the non-college workers used to do relatively prevalent middle skill work in urban areas, and that has completely declined, and it's been offset by movement into services. Nothing similar has happened for college-educated workers. They basically do the same stuff across places. Their tools have changed, their titles have changed, but they're actually doing very similar work. That conceit we have that's changed a lot. What does that erosion of middle skill work, where does it come from? Well, it really comes from two different things. One is the decline of production work, and that's the blue series, and that starts early. That happens between 50 and 70. And then the other is the erosion of clerical work for non-college workers, which happens much more after the computer revolution between 80 and 2015. And so there's actually a simultaneous decline of two categories of non-college work that were quite important, and differently so by gender. Okay, so now I want to sort of try to tie these together in my remaining 43 seconds. So this shows you population density versus the China shock. Really, these panels are all the same, just about. The main thing to notice is the China shock does not occur in the most dense places. It occurs in the middle of the density distribution. The rise in manufacturing employment. So this shows you this history. In the 1950s, it was much more urban. In 1950, it slowly moves out of urban areas and into mid-density places, and then it just collapses from there. And so that was the movement out of the Rust Belt into the South, and then the subsequent elimination or decline. Finally, this just points out that it reminds you that where this occurred were not the most educated places. So the intersection of these two phenomenon is the movement of high skill work into urban areas, the decline of middle skill work in dense areas, and then the China shock kind of piling onto that, because you already had declining manufacturing, you already had declining clerical work, and then that went away very quickly. Okay, so let me conclude. So the puzzle, as was highlighted, regional convergence has slowed or halted, unemployment rates have become persistent. The China shock had these durable impacts. The question is, and we know what those were, and they weren't just earnings, and so they led to all kinds of social enemy that is worth talking about. The question is, was something special about the China shock, or is it something special about the shocked places? Well, I would say it's kind of both, but it's important to recognize that the places that were going to experience the China shock in the 90s forward had a positive pre-China shock in the earlier decades as manufacturing moved in there. And that was creating what was surely an ephemeral state, because there's no way that manufacturing would have stayed there 4 or 5 more decades had it not been for China's rise. It accelerated a process that would eventually have occurred. But of course, the rate of change matters. So finally, and this is the question Ed asked at the end of his discussion, where is the land of opportunity for non-college adults? One reason this shock may have been so enduring is there was no other safe harbor to move to. It's not clear where, everyone says, well, go pack up and move to land of opportunity. Well, where is that place if you have less than college education and you've been doing industrial work for most of your career? And so I think, in thinking about this nexus of policy problems, I think it's important to understand, one, it's not clear where there are better opportunities, but two, there are a number of forces that are going to change that story. The most important being demographics. And we are entering a period of labor scarcity, and scarcity of young workers, and actually scarcity of young non-college workers who are going to be required for services, for maintenance, for cleaning, for elder care. A lot of the problem that we face is not that those jobs don't exist, but they don't pay especially well, they don't offer good careers, and men don't seem to be especially interested in doing them. It's a cultural problem. There's reason for optimism. The labor scarcity or tight labor market is, one of the best policy solutions that we have, although we don't really know how to create it. But the challenge is highly apparent. Thanks very much.
So, like last time, let's go ahead and take a few questions and then turn it back to the presenters and the discussants. So, go ahead and raise your hand if you want to ask a question or make a comment.
Go down if you want. So one of the sort of many reflections that comes out of the China shock literature is that as a profession, because of the legacy of Adam Smith, we were all conditioned to be pro-free trade always. And that's usually the right answer, but it is also true that in 2000, 2001, most people underestimated how disrupting this event would be by a sizable amount. And that doesn't necessarily mean that we shouldn't have supported China's entry into the WTO, but we certainly should have thought about what it would do that was bad going forward. And we should have also sort of thought about which areas are vulnerable and which areas can adapt to the future. And that's, I mean, both of your presentations were quite compelling on this. Is there a future trade shock out there that we should be worried about that's similar? How should we, or are we done with this? Have we gone through everything, or should I be worrying about something else that's going to decimate some region of the U.S. in the future? And if there is, what do you think we should be doing to actually prepare for it in a sensible way?
Anybody else want to get a question in there?
Since I had to wait for Ed, I'm going to indulge myself and ask two questions. So the first one is, why should we consider sort of the stalling of regional convergence to be a puzzle, right? So you have a model, you have stories about why under certain conditions you might have regional convergence, but what are we converging toward? Why do you think that that should go on forever, that it should become a uniform thing? I think that we do need some underlying models that tell us what we should be converging toward. And again, in sort of, having rubbed off from Ed Rosen-Roback, unemployment rates could differ. It doesn't always have to be Blanchard cats. They could just be a compensating differential. And so I think that, it's wonderful that we've been in the data. It's wonderful that we're going to be thinking about policy. Somewhere in there, it would be nice to have a little more theory telling us about how are these things supposed to be linked. That was comment one. The second is, I'm going to really be self-indulgent because I talk a little bit about a comparison. So the shocks that we're talking about, routinization and the China shock, are not local shocks to the United States. They're global shocks hitting lots and lots of places. So I just wanted to mention some work that I'm doing with Eric Menges and Tomasz Mikulski at HEC Paris. And because we're looking at sort of related questions in the context of France, which is looking at some of the same shocks. And so I'm going to skip theory. I'm just going to report a few facts that emerge from ours. One is, in terms, we talk about job exposure, but that's different. Routinization and offshoring exposure is different than total middle skill job loss. And so fact one that emerges from ours is it's actually, in terms of the loss of middle paying jobs, it's the big cities that in percentage terms have the big losses of jobs. Paris about double what it would be in a city of 50 to 100,000. Two is that there's a bias and maybe also why we're not as concerned about the large cities, which are generally going to be similar, the same as the dense cities, is that in France, when you lose lots of jobs in big cities, it's going to be, you have polarization everywhere, but it's going to be 2 high-skilled jobs gained for every 1 low-skilled job or low-paying job gained. And in the smallest cities, it's going to be exactly the reverse. 2 low skill for 1 high skill. Let me just find this. Oh, and then when I think this is very sympathetic, sort of taking into a common time, we're looking at the 1994 to 2015. The story about the time sequencing, New York lost its jobs early, and then its industrial jobs early, and then some other jobs later. It's also true in the cross section that the jobs that you're losing among the middle-paying jobs in the large cities is different than in the small cities. That in the small cities you're still losing those industrial jobs, high and low skilled industrial jobs. In the large city, what you're largely losing are sort of the mid-level professional jobs and to a certain extent office workers and so on like that. So,
all right, let's let you guys respond to those initial questions.
I guess I'll start with Ed's point that we underestimated the disruption. I think that's right. I think in terms of, what do we do about that? I think a big part is that we need to recognize where the shocks will hit. That the shocks are not, the shocks we should know always weren't evenly distributed, and understanding, though, the types of places getting hit really matters. Because if the shocks are hitting higher education places, we can count on just the economy to deal with it in a different way. And if they're perfectly distributed across the country, right, then we just say it's the Fed's problem to deal with. In all seriousness, we just use macro policy, we lift the employment levels back, and everybody's happy. But when they're targeted, it's different. But in particular, when they're targeted at lower education places, I think the argument is they're even more different, and we need to deal with that. As to your question of what's the next shock, I'm actually sympathetic to this view that there will never be another China, right? There's never going to be another place as big and as out of the global economy as China was when it kind of entered the global economy, not just because of WTO, but just their own choice to enter the global economy. And so we're never going to see something quite like that. But I think in general, at least to me, what it says is that we should, every time we're thinking of a policy where we know there are going to be winners and losers, that we have to think extra hard when we know the losers are going to be people in places that are not going to recover as smoothly as places that would recover more smoothly. So that to me is the lesson, at least I take out of it. And then I'll just quickly, before turning it over, as to the other question of, what are we converging to and should we be shocked by something? I guess to me the argument is the level gaps are still massive. And when the level gaps, as everyone is saying, have always been massive. But when the level gaps are massive and you were converging and mobility was higher, I think there was a greater argument that policymakers could say, this is sorting itself out and we should focus on efficiency and aggregate outcomes and not on places. And I think once you have very large regional gaps and no more convergence and less mobility, it does call into question more, are there place-based policies that make sense? And I think that's the argument.
So I'm a little bit less sanguine than Jay about whether there will be another shock or not. In terms of what industries would be most vulnerable, I think we can just trace industries that have moved from the most innovative areas to lower wage areas. Right now, I think that might be some mid and high skill services. So if you read Richard Baldwin's book, Globotics, he has a little bit of that gloom and doom for services, even perhaps college professors in the future. I guess we'll have to see. So in terms of optimality in convergence, I really, really like this recent paper by Pablo Fogelbaum and Cecile Galbert, because it actually brings some optimal tax theory to some of the new economic geography, and it really thinks carefully about spillovers between high skill and low skill workers, including on the amenities side, and it thinks about congestion effects really, really carefully. And what they find is that there is some optimal argument to be made for subsidizing high skill workers in mid and smaller cities, mid-sized and smaller sized cities.
Great. Okay, I don't want to take too much time, but on the, should we anticipate it? It's interesting, actually. I've gotten a lot of personal feedback on from the China Shock paper about who is to blame. So Gene Sperling assures me that it was anticipated and that there were provisions put in place for safety valves in the sort of trade provisions that the Bush administration didn't want to pull the trigger on. So he put, in case of China Shock, pull this lever, and then the Bush administration said, oh, we don't believe in that. So he assures me it was anticipated policy in place. Larry Summers also assures me it was anticipated. I'm taking advantage of him not being here. He's not here, right? And that was the price we just had to pay because China would reform and open. Let's see how that went. Another thing that we thought we knew was that the Trade Adjustment Assistance Program didn't work. But in fact, evidence from Ben Hyman suggests that it actually worked pretty well, although it was way too small and hard to access. So I think that there were a lot. Setting Gene and Larry aside, I don't think most people anticipated this, and I don't think we also understood that we actually had reasonably good policy tools, although they were not set up to scale. In terms of looking forward, I think there are a number of lessons. First, I don't think there's going to be another China shock, but I think there's going to be very disruptive impacts of automation and artificial intelligence. Fortunately, they're going to occur at the job level, not the industry level. And I think that's in some ways better, because when all the manufacturers in a place go out of business, that just sort of takes down lots of stuff. When a subset of jobs are impacted, that has less of the sort of going out of business character, and some firms will obviously benefit. But I think we should anticipate that we're going to face a lot of challenges, that the potential for technological disruption is greater than it's ever been. The uncertainty about how fast things can move is vast. And the lesson is that policies can really help, and that we have a shared interest in making sure that we don't have sustained rising unemployment and concentrated despair. So I think we should be working hard on that. On Don's point, I guess I may have misunderstood the end of regional convergence, but I would have thought Ed's evidence suggests that these places, it's not an amenity value of, they have lower wages, but it's such a happy place. It seems like they have lower wages and everyone's miserable. So I don't see that as convergence in the good sense. But on the sort of the geography of this, I think your work here is really informative, and my work is so far so concentrated on the U.S. and B, as you said, it doesn't have as much theory as some would desire. I think there's a complex story to tell, and hopefully some of the initial facts guide some of that inquiry.
All right, we have a couple of questions over here, far left, in front.
Hi, Amy Schwartz, Syracuse University. So I just wanted to come back to this gender issue, which has been sort of, troubling me. If there are jobs and men don't want to take them because they're of disutility or something, I feel a little bit differently about that as a matter of public policy than I do, or public concern, than I do about there are no jobs. If it's disutility, it's different than if it's discrimination, and we have policy solutions to deal with all of these things potentially. If it's so, I think that it's this is worth spending a little bit more time kind of digging into, and I think that. What that means is that if what we're really going to decide is this is about men, then asking where's the land of opportunity for non-college adults is not really the question. It's where's the land of opportunity for non-college men. I mean, I think, right? But if that's the problem, and we're really not worried about the women in these places, then we should just ask that. I mean, I thought that used to be Alaska. But I've never been, so, but I think that if this is really a gendered issue, then we should figure out what that means and ask, is this something that's going to pass in part as this generation of prime age men moves out of the prime age, and are the younger men different because they, I don't know, have a different utility?
The gentleman right next to you, I think, has a question.
Hi, Larry Katz. One comment and a couple questions. So there was a lot of pointing out of the Blanchard-Katz motivating graph of 75 to 85, but in actuality, that was, we knew that was a bit of a blip. If you'd done this 60 to 70, you wouldn't have found zero correlation. And if you actually look at the rest of the paper, was about the dynamics of adjustment, and as Don Davis said, each region has a different equilibrium unemployment rate and a compensating differential, and we were concerned about how quickly you converge back to that, and that we were very worried, particularly with thinking about European Monetary Union and other things, about places that didn't have a lot of regional mobility. Shocks to particular areas lead to very persistent deviations from their long-run equilibria, and that was a big part. And I think in the European context, that certainly played out, especially when you don't have fiscal transfers across regions. And in the U.S., things have gotten worse. I mean, through the first 80 years of the 20th century, regional mobility seemed to be an important part of adjustment to shocks, and it's really slowed down. And so, we're going to hear talks about that later this afternoon. So a couple questions or puzzles about this. As David Otter pointed out, in the China shock areas, these are not areas that forever had been like high-wage manufacturing stuff where everyone and their grandparents had worked in there. So one of the puzzles, some of it was how rapid the shock was, but these are areas where lots of people had just moved there 20 years ago to find the good manufacturing job. Is why, when the negative shock, in your findings and others, was there so little population movement out? What's happening to the sort of next generation? Is this because of the education of the areas? And so I think that's, is this about, the types of jobs that were available in more positively, shocked areas, just not being very attractive to less educated workers in general, not just men, because the women weren't moving out, very much in response either. And I think this raises the other. When we look at these middle-sized cities and areas, there seemed to be a big growth of jobs, which I would say are not clerical is sort of not the right term. It's really, customer service, social, doesn't have to be done in person. It can be done on the phone. It can be done in a chat box, but it is a set of skills of middle education and interactive skills that don't seem to be done very well overseas, that seem to be, attracting more women in these areas and not men, but it's, there really seems to be, I think, this dimension that David Deming and others have worked on the rise of sort of interactive social skill jobs, not both in-person services, healthcare, but a lot of it being distance, but not being the sort of jobs that manufacturing workers or people servicing the manufacturing sector were well trained for. And I think that's, when we look at the rise of employment in middle density cities, this seems to be a key part.
All right, why don't you guys take those two before we take more questions?
Sure, just because I know there were a bunch of hands, I'll try to be fast. On the gender, I agree with you. I mean, I think especially if the issue is people just won't take jobs, that's a different type of policy problem. But I also think just even if you are looking overall at unemployment rates and labor force participation rates and employment to population rates in these places that are kind of landing in a bad equilibrium, they're really bad numbers for them in aggregate, not just focused on men or focused on women separately. And I think I would agree with Ed. There are big externalities there in terms of what it means to the tax base, what it means to the ability to provide public goods and things like that, that makes this a problem. I do think that part of the solution is, and I can't remember if Betsy Stevenson is here yet, but I've heard her talk about it a lot, of how do you degender some of these jobs. I mean, if you've ever been in a hospital with 75-year-old patients out after surgery, my dad is a large guy, he's 6'8", like the small nurses couldn't lift him, right? And they would need to go find the 6'4" guy who was a nurse, and you need more of them and things like that. Larry, as I tried to mention, I completely agree. I love that paper for lots of reasons, not just the one picture. There's lots of great stuff in there, and I agree with you about that. I think the only thing I would flag where you're saying these places getting hit were the places that everyone had just moved to. The other thing that that's not in this paper but is in the other paper with Katie is it's not just the low education places that got hit harder conditional on the size of the shock. It's also the places where the jobs were already leaving. So it's the places that in some sense shouldn't have been producing the China shock stuff anymore anyway. They just hadn't gotten all the way out of it. That was brutal because then they lost the jobs and there was no way anything was coming back, and they had already been on a downward trend. So it's not just the places where people are moving in, and so I think there's but I agree with you. The question I think comes back to David's question: where were they supposed to go? If it's a mobility question, what was the next other than North Dakota for fracking? Like where were they going next? And that didn't show up until the very end of that cycle. So
on the gender issue. So this is a little bit outside my particular specialization, but I've read articles recently about shutdowns in coal country, and the males who are losing their jobs, their wives are going out and becoming nurses. So it's not the males retraining and becoming the nurses, it's the wives becoming the nurses. But then when I look at the younger generation, so I have nephews who are training to become nurses. So I wonder if some of these things may kind of process out over time. And I kind of hope they do, because my husband was a wonderful stay-at-home father. He got so much flack from that. Even in California, he got a lot of flack for that from all different kinds of people. Even people who would bring stuff to the door during the day, assumed he must have lost his job somewhere. So hopefully we'll sort of get over that over time.
Just very quickly. So on Amy's argument, I agree, but I think that we have to recognize that if men are miserable, they're going to make women miserable too. And we don't have, look, if you look at that in terms of marriage and fertility and, household poverty and so on. So, even if you're like, guys, suck it up, take the job or don't complain, it still has it has costs on the other gender, and we don't have that many situations where men and women move to different places at a large scale. So I do think, there's a reason to want to deal with that, and I agree that, the health service jobs, there's tremendous opportunity. And if you do go into, if you go into a assisted care facility, you will find men in health service jobs, so they're mostly international men, many men from the Caribbean. Hopefully the norms will change. I mean, flight attendants used to be all women, right? That changed, and now I imagine the social barrier to entering that for men has changed, is much lower. Hopefully that will help them with health service work. I think the last question that Larry raised is a really important one, which is, if many of these service jobs can be done at a distance, and they don't need to be done in expensive cities, who will have the skills to do them? And who, how much interpersonal skill, how much education, what are the attributes that can make someone successful at that? And I think, our kind of very casual observation is right now a lot of those are articulate women. But again, we should, if that's a growth area, and it very well could be, we ought to figure out what are the skill sets needed to create, to allow people to take advantage of that opportunity.
So this gentleman here in the blue shirt, you still have a question?
So Matthew Kahn, Johns Hopkins. So is coming back to Ed's question about future shocks, and I know we're going to talk about migration costs this afternoon. If we had different housing markets, if more of us were renters, if we had a less durable capital stock, coming back to Ed and Joe's paper from 2005, how much of a role would that play when the same demand shock hits? The place would clear out, and people who are renters holding a diversified portfolio and not taking the same income effect from the lost equity as the shock hits.
All right, let's squeeze in two more. David Newmark had a question.
And Dick Schmaltzy.
Right here. This gentleman right here. And then, yeah.
Dan Sickle from Wellesley College. So I found really provocative the comments about what might the next shock be. So here's a maybe somewhat unusual possible thought about the next shock, and one that I certainly hope isn't the case, but perhaps is. Suppose we're entering a 20-year period of deglobalization, and we're entering a period of less trade and more trade barriers. Any thoughts on what some of this literature and results in this literature might say about how that world might play out? And again, it's a world I hope we're not getting into, but perhaps unless Ed Glazer becomes president in 2024, perhaps is a world that we might be getting into.
All right, this gentleman here.
Dick Schmaltzy, MIT. First an observation and then a puzzle. The observation is what it means to be a high school graduate differs substantially across the country, as we know. So my guess is that the differences in effective education between what show up in the data as low education areas and high education areas is wider than high school graduation rates would suggest. Education isn't the answer to everything, but as the result of that high education areas respond better to shocks, education's the answer to some things. The question which has troubled federal education policymakers for a long time is what can you do about persistent differences in the quality of education, given the strength of forces for local control, given differences in local tax bases, and given the fact that prior reforms have failed. So I raise that as a policy puzzle because if you have persistent low education areas, you will have persistent, based on this analysis, problems in those areas.
All right, I know that there's other folks who wanted to ask questions, but in the interest of keeping the trains running on time, I'm going to bring it back to the table up here, and we'll head to lunch in a few minutes.
Okay, so very quickly then, on the why not move and would different housing stock lead to it, I think part of the answer is, honestly, not everybody wants to. And local networks of community and family and things like that, I think, are one of the things. But I'll honestly mostly defer to the whole session on migration for people to talk about it. But I do have a comment on the deglobalization. And I think one of the things I think you really can't help but learn from the China shock literature is just how disruptive trade shocks are, right? But I think what we're seeing in the last 3 years is just how disruptive trade shocks are in either direction, right? If you built your entire business around a certain supply chain and that gets broken, your factory shuts also, not just, it can shut for either type of trade shock. The difference is a trade shock of opening brings productivity enhancements overall to the country. You actually do get gains. The problem is we don't redistribute them very well. When you have a trade shock going in the other direction, you just get losses that we also don't distribute very well, but they're going to be concentrated again where there are no winners to compensate the losers. So I think it's actually a really troubling thing that can show up there. And then lastly, on the education thing, I agree with you about what it means to be a high school graduate differs. What shocks me is just how important just getting to the numbers we're using are less than high school as the key variable there. And that has converged around the country over the last 50 years to some extent. The places that used to be 50% no high school are now 20% no high school. But that's still a huge gap. And I think what we see is it really matters being a place with a low high school graduation rate. And so I think any of the policies, whether it's distributing Title I money differently or anything that you can do to try to help these places continue to close that gap is really important.
On deglobalization, I think, so I completely agree with Jay. One more thing I think is relevant is what this does to military stability and whether it would lead to a more violent world. I think there's some evidence to suggest that is the case, especially if it's a tripolar world that we end up in.
Just two quick comments. On deglobalization, I think if we get a lot of manufacturing back in the United States, in the very short run, maybe that will, create some temporary jobs, but it's going to be incredibly capital intensive. It's never going to be mass employment the way it was. On education, there's actually, heartening news on education. The educational attainment rates of recent U.S. cohorts are rising really rapidly. The fraction of 25 to 34-year-olds who have completed high school rose from 90 to 94% between just over the last decade. So in the same age bracket. And the number who have completed a 4-year college degree has also risen by several percentage points, although that may partly be the diluting of the quality of the degree. But in high school, probably not. So there is, education is always the long-run best response. Fortunately, there's a lot of attention to that. But clearly, education is not going to be the short-run solution to a lot of the disruption we're talking about here.
Wonderful. Thanks, everyone. Thanks to the presenters, the discussants. And lunch is out that way.